Good morning, all, and welcome to the DJV Investment Group's advanced trading session. Okay, so let's get started for this morning. Guys, it's a nice Saturday morning in Cape Town. Couldn't have asked for a better day, actually. But okay, for those of you who are joining in and so forth, thanks a lot. I appreciate it. Um, to get us through about what we'll be doing, okay, I just wanted to take a quick little recap, I'd say, and get you guys to understand exactly, what you're letting yourselves in for and what you'd need to prepare with and so forth. And also what I'm going to want to do is I'm going to want to tackle basically what we call referred to as certain truths within the market. Okay, there's been a lot of false perception that has been created within the markets, and that is some of the things that I kind of just want to clear up with all of you, because I'm pretty sure that you guys already have got a particular perception about the markets, however it may have been formed, and I want to challenge those perceptions. Okay, it's basically to give you guys a different angle to view this on. Okay. Right. Now, more importantly, let's look at the different types of things that you're going to be learning within these sessions, these courses. Okay. Now, today is obviously the first one. Yeah. What we're going to be doing is we're going to be looking at all the market basics, and we're going to be taking basically all the theoretical material that you've been working through, all those hours worth of video sessions that you've done on your own at home, via our online school, will kind of be handled today. And we're trying to take those little puzzle pieces that you've been learning now, and I'm going to start building that puzzle for you guys so that you actually start seeing and understanding exactly, okay, how each little part and piece fits into one another. Okay, right. Now, as well as with that, what we're going to be looking at doing as well is we're going to have 4 of these sessions that's going to come round. Okay, so you're going to be doing today's session, obviously. In a month's time, it'll be session 2, and each month, we'll go on until session 4. So session 1, we cover all the market basics. After the session, okay, once we're done, session is recorded, so you guys can go back and view it again. But what's going to happen is I'm going to send you guys an assignment as well to make sure that you actually understand what we've been delting in class. Okay. The other thing as well is that it's extremely important, okay, to actually complete that assignment. If you are at any point in time just gonna think that, just check the videos and sit back, relax, don't worry about doing anything, don't do any practical or anything like that whatsoever, well, I can tell you now you're gonna have a difficult time. Okay. There's no way that I can help you unless you do the work. Okay. So, need you guys to make a promise to me now. It's the fact that you will put in as much effort as you can to make this work. And if you promise me that one little thing, okay, now I'm not saying push everything aside, okay, and only focus on this. No, not at all. All I'm saying is try to give at least anywhere from 10 till about 30 minutes a day, playing around on the charts, doing some of the assignment work, just getting a daily habitual thing going with this. Okay. As long as you do that, I will try double as much to make sure that you get this, that you make it, that you're making money. Because that's the key factor. Okay. I mean, I always ask everyone when they start with a new class and so forth. Okay. Why are we all here? And the answer is always the same: to learn how to make money. Okay. Difference is we're just doing it via a different route than what most people are used to. Okay. Others use investments, business opportunities, property investments, all those different types of things. we will be using active trading on the financial markets. Okay. Now, what I'm going to be teaching you guys is the set skills that are needed in order to become a fully self-sufficient pro trader. Yeah, what does that mean? Well, if I'm going to take you guys and drop you off on a remote island, okay, what it means then is that with the skills I've taught you, you will be able, as long as you have got a laptop and an internet connection, you will be able to trade anything on any market, develop a strategy for any chart that you're looking at, and make money off of it. Over and over and over. Doesn't matter what I throw in front of you. And that is the key skills that sets us apart from every other trader out there. Okay. A trader needs to be adaptable. So you need to understand the basic skills needed to become as adaptable as a pro. Okay, and that is why we take a specific set type of process with this course. What we try and do is we try and teach you, okay, certain set habits. Because what is a habit? A habit, all in all, is something that you do on autopilot. Okay? It's an automatic behavior. It's something that is ingrained into your subconscious. So you're doing it over and over without even thinking about it. It comes naturally. Now, how is a habit formed? And this is the beautiful thing. Okay. We can form as many habits as we want to. The key factor is that it takes daily practice, basically. Day in and day out for at least about 21 days. And once you've maintained that daily interaction, slowly but surely you're going to notice that it actually starts becoming second nature. Once it starts becoming second nature, voila, new habit is formed. Okay. Think about it the way in which you started to learn to drive a car. Okay, for those of you who drive cars. Think about that day that you went for your driver's license. How nervous you were. Okay. How you had to think every little step through. Okay. When you're driving and you're getting to basically a stop sign, and all of a sudden you need to halt the car. So now you're thinking, okay, wait, what do I need to do now? Okay, foot on brake, push pedal. What else? Yes, I need to obviously put in the clutch. Okay. Which gear now? Okay, let's put it in neutral or whatever. And so you go on about it, just thinking every little process through. So because of that thinking, it kind of slows down your reaction time. Okay. And that is why we drive so freaking slow when we are, doing our driver's tests in that sense. We're obviously nervous and that kind of thing. And it's a skill that's not yet mastered. Okay. So when do you really learn how to drive? Well, only once you've passed your learners and you've been driving for a little while. Think about it this way. How are you driving now? Okay. If you drive anywhere, to work and back, or picking up the kids at school, anything really, what's the thing that you do? You get in the car, start it up, and you start driving. What happens? You get into this mental process of starting to think about 100 other things while you're driving. So you're driving on the N1, okay, on the highway, flicking, between and through cars and so forth, changing from lane to lane, all while you're thinking, I need to remember to get some bread and some milk. Oh, some coffee as well. Okay. So there's 100 of, different things racing through your head, and not one of them is actually concentrating on the road. Okay. Yes, we do concentrate, but the funny fact is that most of these actions actually happen on autopilot, and it's because of the fact that it's a habit now. Okay. So that's why what we're going to do is we're just going to ingrain the proper trading habits. But if you're not going to put in the practice, you're not going to create those habits. And guys, then I can't help you. Okay. You can lead a horse to water, but damn well if I'm going to try and force you, I'm going to drown you. Okay. This has got to come from yourself. Okay. Right. Now, let's get a little bit more serious now. Okay. One of the things that I need you guys to understand as well, okay, is that there is no such thing as a silly question or anything like that. The fact is what I want to make sure of is that there is no doubt whatsoever within anything that you're trying to learn or do within this course. If you at any point feel a bit overwhelmed or that kind of thing, drop me a mail. Ask me, okay, exactly what the issues are. There's nothing that I really can't, answer for you at all. I mean, I've been in this game for years. I've been trading for quite a while. Um, and believe it or not, but guys, I've wiped my own live personal trading account twice. Okay. Not a fun thing to happen. So, it wasn't a fun period and that kind of thing within my trading career. First time was basically, when I just started out, didn't know much and that kind of thing, and I tried a dab at it. I knew the power that this had, seen it, from other traders and that kind of thing. So I thought, well, I might as well, take a stab at it. Went in, lost it all. So I thought, okay, let's get a little bit more serious. So started doing quite a couple of courses, 1-day courses, 3-day courses, going to seminars, those type of things. Spent a heck of a lot of money on being taught how to trade. So at a particular point, I knew exactly what I had to do and needed to do in order to, make the money. But as I started with my second live account, I encountered a completely different kind of problem. Now I knew everything that I needed to know. Okay. I knew exactly how I had to go about it, when I had to take my signals, all of those different things. And things were going great. Okay. I was making a heck of a lot of money. Problem was is that I started to develop this false sense of security. Okay. And because of that, unfortunately, okay, what happened is that I started thinking that I could predict the markets. Oh boy, was that the wrong impression. Okay. I thought that every trade I touched turned to gold. I really actually thought at a point I could predict the market. Okay. Boy, did I learn the hard way. I got so into it at a point that, once I started getting some losers in that sense, I couldn't take the fact that I had a drop in my account. And that is when the emotional side hit me. Okay. Got into the downward spiral, which is revenge trading, taking back what the market has taken from you. And I literally wiped my account in about, I think, 2 hours space. Can easily be done. Okay. But those are in the past. And they're probably some of the best things that's ever actually happened to me. Okay. I'm thankful for those experiences because it taught me, firstly, to respect the market for what it is. I know for a fact now that no one, and I mean no one on this planet can predict the markets. So don't even try to. There's no way you're going to be able to predict it. Okay. It's wasted effort. It's wasted time. Do not bother. It only gets you into more trouble. Okay. So lessons learned, but I came out of it as a stronger trader. Okay. Obviously, I know about it feels, I mean, you get so despondent. You don't want to do anything involved with trading after that and that kind of thing. But it took me about just a couple of days, regrouped myself, and I knew, okay, I needed to start taking this a lot more seriously. Okay. Because I'm just screwing around with my own money. That's when I made the decision to actually start focusing on this in a business-like sense, I would say. So here's the first little thing I want you guys to start understanding about trading, okay? Especially with the type of trading we are going to be doing. You need to view this as an extra little business, okay? This is a business. Remember, why are we all here? We're here to make money, okay? And the fact is that trading in itself is like starting up your own little business. Now, let's hear it. How many of you think that trading basically is gambling? Same as. Well, I'm probably going to get quite a handful, okay, of you thinking that. All good. You can think whatever you want, okay? But let me challenge that perception. Like I said, guys, I'm going to start flinging around, flinging around quite a couple of different truths about trading. I'm going to be busting certain truths. And I'm going to kind of show you exactly what it's about from a pro trader's perspective. Okay. A lot of you are going to do this course, especially we're going to tell other people, no, I'm learning to trade the Forex markets or the financial markets and that kind of thing. People are going to look at you dumbfounded. They're going to tell you, are you mad? You're just throwing your money away. Okay. It's all gambling and that kind of thing. I mean, I've heard it over and over and over. I still hear it from a lot of people that don't know me. But those who know me, they've seen my accounts, and funny enough, all of my close friends wants me to trade for them, or they want me to teach them at this point in time now. It's funny how it happens, you know. But people are skeptics, and it's understandable. Okay, I mean, I'm a big skeptic as well. Okay, with a lot of things in that sense, and you can only really believe it once you see it. And that's what's happening there with all those friends of mine and that kind of thing. You know, clients I've been working with and so forth. It comes down to the proof in the pudding. Okay. And that's why, guys, through this journey as well, once you start getting onto session 3 and you've finished with that, you start qualifying for our live trading session. So you'll see me in action with live price. You see exactly how I go about taking my trades and so forth. Okay. And we can play around with any type of system and that kind of thing, but it's to show you the proper process of application that you need to take. And that's the big thing. Okay. The biggest killer and enemy within the markets here, it's not going to be the broker. It's not going to be other traders. It's not going to be news releases or anything like that. It's going to be you. Because the biggest battle you're going to have within this is the emotional battle within your own mind. Okay. That's why in session 4 we focus completely on psychology on its own. Okay. It gets a full day on its own. It's that important. Okay. Getting back to the gambling question. Okay. Is trading gambling? Well, short answer, no, it isn't. Now a lot of you are asking probably, but how can it not be gambling if I do not know what's going to happen next? Okay, let me ask it to you this way. Okay. What does the casino do? Do they gamble? Or are they a business making money? Think about that for a minute. Okay. Any of us who've ever went or gone to a casino, we all know what happens. Flashing lights, you know, a lot of excitement and buzz in the air, that kind of thing. Funny enough, I'm not really an avid gambler at all. I really don't like gambling. I just feel it's a waste of time and money. But it's a personal kind of thing again. I mean, I've been to the casino a couple of times, that kind of thing, but it's only been watching friends play and that kind of thing. I mean, I'm one of those guys, I'd rather give a couple of bucks to a friend to play it on my behalf rather than me playing. I just don't see the need in it. Okay. I enjoy watching the people a lot more. But here's the thing. You either win or you lose. And the fact is what do we know? The house wins in the end. Okay. The casino's there for one reason. Not to give entertainment. For goodness sake, no. It's there to make money. Okay. The question is, how do they do it? That's the real question. Okay, think about it. If you know the game blackjack or poker, these are card games and they get played on the tables. Okay. At any point in time, do you think that the casino or the dealer knows exactly which card is going to come out on each draw? There's no way. There's absolutely no way. Okay. So, how does the casino make money on those games? If they've got no cooking clue as to what is going to happen or transpire with a pull of each card, how do they know or how do they make money at all on those games? My friends, that is trading. Very simple trick. All the casinos do is they make sure that they stack the odds into their own favor. This means that they know they've got no cooking clue what's going to transpire, but they do know the chances of X happening over Y or A happening over B and so forth. Okay. They've basically got a system put out for them. And all they need to do is follow this system to make sure that they keep the odds in their favor. Okay. So how do they control the odds? Well, it's quite simple actually. It's normally set to the way that the dealer deals. Okay. The number of decks that they use. And you'll notice as well, even the payout system is set in such a way. Okay. So that even if you win, it's not going to hurt them at all. Okay. It's like a little risk protection setup that they've got. So the fact is they know they're going to lose money. But that's exactly what they want happening. Because by losing money, they pull more people who will put in more money. And that's how they make their money. Okay? It's purely based on a set of odds. No one at that casino's got an idea of exactly what's going to come out next. They only know the chances of something happening over another. Okay? And it's that exact same process that we use within our trading. Okay? Therefore, trading, especially when you're trading like a pro, is like setting up your personalized little casino that you're the business owner of, that you're controlling. As long as you make sure the odds are in your favor, you should not have a problem whatsoever. Okay? And that's the beauty with trading. So yes, all those is saying, oh, trading's gambling, you're just throwing your money away. If you don't know what you're doing, well, fact, yes, you are gambling. You are throwing your money away. That's fact. There's no other way around that. But if you know what you're doing, you understand the risks involved. And it's that way with anything, guys. Anything. Okay? Think about it this way. What's the success rate of a business? Okay, within the first 3 years, how many of them survive? It's a dismal number. Okay, it's a very small number. Okay, see, we've got someone else online here. All I'm going to do is I'm just going to, oh, it's Henry. How are you doing, buddy? Okay, I'm just going to set your mic off. If there's any questions or that kind of thing, okay, then by all means, head through. You can use the chat feature within the group chat. If there's any questions, just type in and that kind of thing. But okay, then I'll just switch your mic on if we need to converse and that kind of thing. Otherwise, yeah, like I said, just use that feature to ask me any questions and so forth that might pop up. Okay. Getting back to what I was saying though, okay, is the whole thing that you're going to realize though, okay, is that having set up trading as your personalized little casino, okay, makes it so much simpler for yourself because you know what to control. You know the danger points and all these different types of things for yourself. Okay. Businesses, though, like I said, success rate over 3 years. Okay. Well, I think the stats are dismal. From right at spot, only 10% of businesses within 3 years actually survive. Okay. And if you think about that, statistic, if only 10% make it within the first, why start a business? Why do you think so many people are trying to start their own businesses? Okay. You see, the fact is that anything that's going to give you a good chance of making money or making income or making any type of returns is going to carry a certain set amount of risks. Now, why do so many people fail when starting a business? Truthfully, they've never assessed the risks properly enough. Okay, they go into it blindsided. They don't have a cooking clue as to how to analyze exactly what's going wrong, where the issues are, how to analyze their own accounting statements and so forth. Okay. And all of that creates more problems as the business keeps on running. It's the exact same thing that happens within trading or investing or anything like that. Okay. Actually, the success rate within trading itself, we'll get there in a minute. Okay. But it's very comparable towards the business sector. So if it's so risky, why do it? Like I said, why did Richard Branson start a business? Okay, it's not because of the risk. It's because he wanted to push the boundaries. He wanted to be his own boss, be his own man. Okay, live the life he wanted to, and that's the main thing. It's just about thinking why you're doing this. Okay, I know I'm talking quite a lot at this point in time, trying to talk around a couple of things and so forth. But guys, I really want to take this first session to kind of restructure your thinking towards trading because this session is very important to kind of lead you up to the next sessions. Okay. If your mindset isn't correct, then this is going to be a difficult thing for you. Okay. So we just need to gear those mindsets correctly. Like I said, you're going to get a lot of naysayers telling you, you're throwing your money away, you're gambling, and that kind of thing. You already know for yourself now. And here's the fact, guys, I never try and argue with anyone when it comes to that because there's no use. If you're going to try and argue with an idiot or a fool, you're only dragging yourself down to their level because no matter how much explanation you're going to give, I mean, an idiot is just never going to budge. Okay. They believe full heartedly, without a doubt, the biggest lies, funny enough. Okay. And they don't even know how to do the proper research in terms of finding out whether what they think is actually true. Okay. It's always, I know someone who knows someone who knows someone who's had this happen or that happen, and that creates the perception. Fortunately, most people think that way. Okay, so luckily there are the few of us, the handfuls within this world, that actually open ourselves up to different types of perceptions. And that's the key factor. That's what actually sets you ahead of the pack because you can anticipate a lot better than most of the others. Okay, right. Now, like I said, okay, the fact is anything that you're going to try and do that's going to make you money, whether it's property investing, okay, even that carries some huge risks. Okay. The fact is you always need to be able to assess where the danger areas are and at least cover them to protect yourselves from any of those risks. Okay. So like this, if you know how to assess risk properly, well, you've eliminated most of it. Okay. There's always going to be a certain amount of risk. It's about how willing you are to take that risk and at least setting up measures to soften the blows if it does play out. Okay. It's all you really need to know in order to survive and trade for a lifetime. Okay. Right. So like I said, okay, accept the fact that no one knows what's going to happen next within the markets. Okay. Like I said, I thought I could predict the markets. No one can. Okay. Not even Warren Buffett. Okay. No one at all. Think about it this way. An economist, they've gone to, college or university for quite a couple of years to pick up the skills to be able to assess the markets, okay, from a proper point of view. And if you actually listen closely to any of the interviews that are had with any of these economists on the business news, listen closely to the wording that they use. Okay. So there's maybe some deal in China that went off, and there's a bit of sour grapes and that kind of thing about the deal. So you normally find the reporter asking, to the economist, so because of, X, Y, and Z, what do you think the implications would be for investors on the markets? And listen to the way they respond then. Well, we could have, there should be, we might see. Okay? They will never, ever, ever give out any fact or so forth about any happening that could come up. Because the fact is that they know what could happen, but they've got no cooking clue as to what is going to happen. Not even they can predict. Okay? So firstly, accept the fact no one can predict the markets. Don't even try to. It's wasted effort. You're only going to make yourself work a lot harder than what you're supposed to. The fact is, okay, trading, guys, is actually very easy. The problem is especially as novices, you know, you tend to make it more difficult purely for the fact that you think the more difficult your systems are, the more difficult the approach is, the better you will do. In fact, that's not the case. You only really start doing better once you understand the proper principles, the proper approach. And once you've got that application down, you will notice yourself that trading is actually quite easy. Okay? Because all you need to do is the same thing over and over and over and over. Okay? The difficult part comes in controlling your emotional side. Okay, especially when you're going to be gaining a couple of losers and so forth. That's normal. Okay, so that's one of the other kind of truths I want to get out of the way. Okay, so firstly, you all know at this point in time, okay, no one can predict the markets. Okay, secondly, this isn't gambling. Okay, this is like setting up your own personalized little casino. Okay, and third thing basically is the fact that you are gonna lose money. Let that drop in for a minute. So if you're going to lose money, why do this? Sorry, just had a sip there, coffee. Anyway, so why do this if you're going to lose money? Think about it. What I need you to understand, guys, is that losers are part of the trading game. There's no system out there that produces a winner every single freaking trade. So do not try to get yourself up to those standards. Okay. Most people have got such a misconception on trading that that's insane. Okay. I'll give you guys a little example in a minute or two. Okay. But firstly, in order to get the winners, we need to sit through a couple of losers. We do not know what's going to happen next. We do know that every now and then we're going to get something going against us, and it's all good. It's all good. Okay. If the market didn't go your way, it doesn't mean you did anything wrong. It just means that the odds did not play out. Okay. I find a lot of traders tend to, it's always, the novices who start out, they always tend to blame themselves, okay, for trades not going the way. Um, they've got this perception that they're doing something wrong. The fact is, if you're following the rules, you're not doing anything wrong. It's just that the markets isn't playing out its odds. We need those. We need to get through those. Okay, it's the normal cycles of the market. You're always going to have losers coming in. Okay, guys, I get a lot of losers, but I make money. The difference is I make sure that I make a lot more when I win compared to when I lose. Okay, I only ever risk 1% of my trading capital in total per trade that I take, and I try and make a lot more. Okay, I'll push for a minimum of 2%. If I can get more, I'll grab more. Okay, depends on the system I'm trading for the day, or the uh, approach the market's taking for the day as well. Okay, but in the end, what you're going to notice is I'm going to start building you guys up so that at a particular point you're going to have more than one system, because a pro trader doesn't only trade one strategy, he trades many strats, many approaches, because one particular strat will only get you into one particular market cycle, and only when those cycles come up do they produce entries again. Otherwise, most of those entries that are going to come up are going to be false signals. Okay, and market cycles changes continuously. This is why I do not believe in giving out a set system just like that. Okay, most people can't make it work because they don't understand the basic constraints that come within certain assets like that. Okay. What happens is that when giving out a set system, you need to be able to duplicate every single thing of that system. If it needs to be traded from 9 in the morning till 12 in the afternoon, you can't freaking expect the same results if you're going to sit in from 3 in the afternoon till 6 in the afternoon. That's just idiotic. Okay. It's like saying, I expect to hit a land speed record in a car, okay, by driving on a normal, tarmac road. But then I changed the conditions and I set everything set up basically on an old dusty type of road with potholes and those type of things. How the freaking heck can you expect the same results then? It's a completely different situation. Okay. Just like that, the time differences within the markets are completely different from one another. You've got a completely different continent on the market at that point in time. Okay. So you can't expect the same freaking results by using the same system in a completely different way. It's like trying to bake a cake. Okay. Think about it this way. I'm giving a cake recipe out to 1,000 people. Okay. It's the exact same recipe. I tell them to come round and back with a cake the next day. What do you think is going to happen? No one is going to come round with the exact same freaking cake. Okay. Firstly, conditions in the ovens vary. Okay, certain people use Fahrenheit, other people use Celsius and so forth as the measuring tool instrument for basically the different types of heating levels within the ovens. Some have got convection ovens, okay, some have got normal element ovens, others have got gas ovens. Okay, all these conditions vary. Therefore, you're going to find some have got cakes that are burnt, flopped, and so forth. Well, some might have a brilliant cake. Okay, it's the exact same recipe, but no one came around with the exact same result. Okay, it's because every single one of us is different from one another. We're all individuals. Okay, This is why, I mean, I've worked at quite a couple of places that have taught people, and I've been taught at quite a couple of those places as well. Okay. But they teach people a set strategy. It never works. Okay. Purely for those reasons. The penny only really dropped with me once I started doing my own thing and broken away from those masses. That's why I realized that trading is actually so easy. We make it difficult for ourselves. Okay. We think that we always need to jump at that next winning system, next winning system. Okay. Guys, there is no such thing. Okay. System's a system, and every single system will have losers. Okay. Some more than others. Some will make a lot more profit than others as well. But the trick is to be able to identify which niche you're going to be falling into. Okay. What's going to fit you best? Because you need to first look at time constraints. What's your time availability like? Okay. That's going to be the main factor that's going to determine how you're going to go about this. Now, I'm an intraday trader, so I sit from basically 9 a.m. every morning till 12 noon. I trade for 3 hours only each day. I don't want to trade longer. Why? I don't want to sit there for a full day. Yet I've got clients who do this as a full-time job. They actually sit and trade from 9 to 5. Okay. I've got another client up in Joburg who owns a paint and hardware store. Okay. He's been trading live for about, what, I think 2 years now. Okay. Taught him everything he needs to know and that kind of thing. And he's been coining it big. Okay. He basically gets into the office at 6 a.m., locks his office door, takes his phone off the hook, and he sits and trades for a full 6 hours until 12. Then only he unlocks his door, puts his phone back on the hook, and tells his secretary to send all the messages through. Okay. But he basically sits and trades uninterrupted for 6 hours straight, all while having a full-time job. Okay. Every single one of us is different. Not all of us have got those type of advantages though with our works, because I mean, like I said, he owns that place, so you can go about it as he'd like to. Okay. But some of us, we are stuck with, not being able to take advantage like that within our jobs. And this is why, I mean, if I'm going to teach you on my system, not every single one of you are going to be able to trade it. I mean, no one's been able to use my system yet. Okay, they've tried it, but they can't get it right. It's because it's not that it doesn't work. It's that it is one of the most difficult systems to try and trade emotionally. Okay, you need to have a bit of experience before you can master a system like that, because you need to be able to master your emotional side within trading first before really successfully applying a system like that. Okay. Um, but I do share my system freely to everyone. Okay. You guys will see it in the live trading sessions, those type of things. It's a system I've been using for quite a while. Okay. Now, like I said, guys, the big skills I want to teach you guys is to be able to set things so that it fits your personal trading style. Okay. Now, what if you can't trade intraday like I do? Sit for a full 3 hours. Well, why do this? Here's the thing. Okay. You don't have to trade intraday. Nothing says you've got to. Why not trade end of day? Okay. This doesn't mean go and sit 12 at night, wait for the end of the day, and then take a trade. Okay. No, this is only what we call analyzing a chart that uses daily prices. Okay, or daily candles. By the end of today, all of you will know how to read a candle chart, bar chart, line chart, all of those charts. Okay. So we're getting there. Like I said, just forming the thinking patterns at this point in time. Okay. Now, again, what we need to understand though, okay, is that with end of day trading, you're only going to put max about 30 minutes a day into your trading. You only need to look at the charts once a day. So when you're especially pressed for time, end of day trading is going to be the best solution for any of you. Okay. Nothing stops you from trading intraday and end of day. You can really format this in such a way so that it fits you as the individual. That's what I want you to do. Because here's the thing, your situations are going to change every single time as the years continue. You might get a new job, you might move even to another country. Okay. A lot of different things can happen. I mean, there's life throws everything at us, and we need to be able to adapt. And that's why I need to teach you the proper set of skills so that you can become adaptable within your own trading. Okay. That is what's going to get you to be able to trade for a lifetime instead of trading for a couple of months, losing all your money and starting from scratch again. Okay. I mean, guys, been there, done that, got the t-shirt, burnt it, just doesn't freaking work. Okay. Again, when there is any type of doubt with anything that we're going to do, guys, please make sure to rather let me know. Okay. Do not try and go ahead with anything without checking with me first. Please don't. Okay. Do not listen to a broker. Guys, they're called a broker for one reason. They're there to make you broke. Okay. I've had the unfortunate event of one of my clients a couple of years ago. Sign up for the course, that kind of thing, all excited. But unfortunately, a broker phoned him, told him, sir, you know what's going to be a good investment at this point in time? Soybeans, And the problem is that this client obviously had no cooking clue as to how to go about trading. And here's the thing, those brokers, they don't care. They do not care what happens to your account because they get paid no matter what. Harsh reality, eh? The one thing you always need to ask yourself whenever dealing with any type of broker or even a financial advisor, and sorry to any of you who are financial advisors, all those type of things, but I hate financial advisors. I hate them with a passion. Okay. I'm not going to lie, you do get some brilliant financial advisors. Okay. The only problem I've got is that they're too, a few and far between. Okay. Unfortunately, the bulk out there, they're looking out for numero uno. Okay. They're basically making sure that whatever they're selling is good for their pockets. So they don't really care about what happens with the clients. That's why we're having such issues as well. Okay. Everybody's only worried about themselves. That's the wrong type of attitude to have, though. Okay. This is why you've just got to ask yourself, actually, and it's going to be the quickest way to determine basically whether, this guy's actually trying to con you or whether they're really looking out for your interest. Okay. But it's to try and find out how they get paid. Do they get paid a commission on the growth they make you? Or do they get a monthly premium for the type of service that they sold you? All of that makes a difference, okay? Because if they're only going to get paid a certain portion or commission on whatever product they sell you and not on growth, do you really think they're going to care about the growth you make? They're going to punt you the first thing that's going to make them the most money. Think about that, okay? So why the freaking hell listen to them? Okay. This is why you can't really just trust anyone when it comes to matters of money. You need to do due diligence. Okay. You need to sharpen yourself up as much as possible. Okay. So that you don't get tricked, you don't get scammed, you don't get fooled. Please, as well, if you're looking at going for anything that's gonna make money online, okay, like going for a managed account and people trading it for you, or buying a trading robot online, any of those, guys, please, please, please do me the favor and make sure that you contact me first, to rather just check it out and see whether it's legit or not before you jump in for something like that. The problematic thing is that about 90% of the things out there are all scams. Okay. And there's nothing worse for me than to see a client lose money. Okay. Well, it's me losing money, obviously, but I know that feeling. Okay. I've been through it and it's not fun. I don't want any of you to get to that place. Okay. You need to really take this with a lot of responsibility. Okay. Because in the end, guys, the only person to blame is you, because you're the one taking the actions on everything. Okay. Okay. Good stuff. I think I've preached enough for now. But like I said, guys, the main thing is I just want you guys to kind of understand the approaches, the ways in which we look at this. Okay. Just get those mindsets right in the beginning, so that you understand what you're letting yourself in for. And like I said, guys, this is a completely open thing. If there's any questions at any point in time, let me know. Don't be afraid to kind of, just give a shout out, that kind of thing. Um, I'd rather make sure that all of you are 100% fine with understanding all the different angles that we're looking at and taking and so forth. Please make sure you complete the assignments I'm going to send you, because if you don't, well, I can't help you. Okay. The assignments are there for a reason. It's for me to see where you as an individual are having issues, so that I know what to focus on with you in particular. Okay. You're going to notice every one of you is going to be completely different from one another. Every one of you are going to have completely different strategies from one another as well. Some of you are going to trade intraday, some of you are going to trade end of day, bulk of you end of day, basically. Okay. And the other thing as well is that we've all got different type of risk profiles and exposures that we can take and so forth. So this is really going to be molded and adapted to what you feel comfortable with. And that is what I believe makes a pro trader. Having that skill to be able to adapt to the market in a way that fits you, not following someone else's rules or recipes. Okay, because that's what they want you to do. That's why so many people fail. Okay, they jump in blindly without really knowing what they're supposed to do, and they get burnt. Okay, do not be a sheep. Okay, right. Now, remember when I asked you about the success rate, okay, within a business? What do you think the success rate is when we're looking at something like financial markets? Well, trading. Okay. Let me quickly. Okay. So the big thing that you're going to notice is that a lot of people don't make this. What do you think the percentage is? Well, let's say it like this. What's the percentage of people that actually make money in trading consistently? Okay. Not once off, consistently. Guys, something dismal like 10%. It's actually under that. Okay. Now, that's not good news, is it? Think about it. Why are we going to trade if only 10% make it? Why do people start businesses if only 10% make it within the first 3 years? Same thing. Okay. The fact is that 90% of the people out there haven't got a cooking clue at what they're doing. That's why they fail. Okay. It's the same thing as if you're going to take a freaking toddler and put him behind the wheels of the car. Okay. What else are you going to expect? That car is going to get damaged. Okay. Um, and I'm sure none of you are going to get on any plane that's going to have an unlicensed pilot that's never flown before. Okay. It is a sad fact. Okay. But the beautiful thing is that with the skills I'm going to be teaching you guys, okay, you will be put into the top 5% of traders out there. Okay. As long as you keep on doing what I'm teaching you, you're going to be fine. Okay. Yes, some of you are going to veer off the road. It always happens. Okay. It's expected. But this is why. Okay. Whenever that happens, guys, I need you to communicate with me. Okay. So that I can pick up the issues that are popping up. I can warn you ahead of time about certain things that you need to watch out for. And at least you can safeguard yourself then. Okay. I mean, I've had a handful of clients who, and I want every single one. Talk to me before you decide on going live. Okay. Trading with real money. I've had quite a handful that's not done that. They've gone live, traded. And then the only time I hear from them is, I've lost all my money. I need help. This isn't working. Okay. Again, like I said, if you're not going to tell me anything, there's absolutely nothing that I can do. Okay. But if you keep communication with me, I can keep an eye on exactly what's happening, all the different proceedings. Okay. And I spot quickly when you're losing discipline, when you're being influenced by emotions, all those different things, because I've been through it myself. I still go through it every single day. Okay. I still get emotions running rampant and that kind of thing. The difference is I've learned to master not to act on them. It's fun to have them. Okay, that's what I enjoy about trading. But the trick is to master that skill about not acting on them when they come. Okay, and that's really it. Okay. So now that you know that, let's get started. Okay. Now, okay. You guys should have gone through the videos at this point in time. Okay, if you haven't, not the end of the world. Okay, just revise them after class. Even those of you who have watched. Okay, make sure that once we're done with this session, you just revise those video sections. Okay, because after we've dealt with what we've gone through today, you're going to notice that everything's going to make a lot more sense when you go through those videos again. It's all gibberish, especially when you start out with this the first time round. There's going to be a lot of market terminology that we're going to be using and so forth. Guys, I mean, I've been doing this for a while, so I'm going to mention probably quite a lot of terms that's going to go past you. But if I do at all, any point in time, mention a particular term and you're unsure of what I'm talking about or what I'm saying or what the term means and that kind of thing, please stop me. Ask me to kind of explain it to you guys, um, because it does happen. I I can't always, remember that the novices don't know that or they don't know that. Everybody's at a different level from one another. Okay, so when you stop me, I'll definitely kind of explain in detail what I mean by it, that kind of thing. And if need be, we'll go into further detail and just tackle it from a different view. Okay, right now, again, first things first. what is the difference between trading on something like the stock markets compared to something like the OTCs? Now, firstly, what does OTC stand for? That was in the videos. Over the counter. Okay. Good thing it's not called UTC. Dodgy dealings. Anyway, now that you know what OTC stands for, okay, question is, what is the stock markets? Okay, now, this is what I want you guys to understand. Stock market, okay, and listen very closely to the following wording. The stock market is a gathering place for like-minded investors to swap units between one another. It's a gathering place for like-minded investors to come together and swap units between one another. Okay? Think about it this way. If I gave every single one of you, let's say, 10 shares in whatever particular company, let's just say Volkswagen. Okay. All know about the old debacle with Volkswagen and the CO2 emissions and those kind of things that were lied about, being hit heavily now. Stocks drop, that kind of thing. But imagine you had to go and sell that now on the street. And I'd give you guys 3 days to go and sell those 10 shares that you've got. But here's the trick. You got to sell it for a profit. And it's got to be on the street. Random stranger. How easy do you think it's going to be? It's going to be freaking difficult. Okay, there's nothing you're really going to be able to achieve in essence, because problem is that the normal Joe on the street doesn't really know a lot about this. Therefore, they're going to try and, kind of just steer away from it. Okay, not be involved in the conversation and so forth, because they know they're getting themselves into things they don't know nothing about. And this is why the stock market has been created. It's so that exactly these like-minded type of investors can get together and then swap these different types of instruments and units between one another. When I'm talking about an instrument, I'm not talking about a guitar or drum set or a trumpet or anything like that. Okay, it's not musical. Instruments in the trading world refers to anything that can be traded. It's a collective name, basically. Okay, so the euro US dollar is an instrument. Okay, a forex chart. Okay, the Volkswagen shares is an instrument. Okay, unit trusts are an instrument. Okay, bonds, derivatives, indices. Okay, there's many different types of instruments that we can trade, but it's basically literally anything that can be traded on the financial markets. Okay, so the overall name for any of those is what we refer to as an instrument. Basically anything that can be traded. Okay. Now, the stock markets, though, okay, what you're going to notice is that you're going to have different things available to be traded on the stock markets. Okay, the stock market is also a highly regulated place. Okay, now what you're going to have available mostly, and what most of the people out there know, is obviously shares that can be traded. Okay, so you'd be able to purchase company shares, sell them off, as they make profits and that kind of thing. But there's a problem with those. Okay, and that's the problem I've got. You can only make money on shares when. Yep, that's right. You can only make money when the market's rising. So what do you do when the market's falling? Well, you put your hands in your hair, you just grab tight and pull, because you're going to be losing money. Okay. Now, the big thing with this is that it means that unfortunately we need to sit and wait for the market to start turning into what we call a bullish direction once it's been falling for quite a while. Okay. And if there's no money to be made in that section, why get in? Okay. But that's the thing. I don't like sitting out. Okay. I mean, if you can only make money when the market goes up, what's the use? Okay. I'm not against shares at all. No, I'm not against it. Okay. But for trading, income wise, that kind of thing, there's no use in going with shares. Shares is more for a long term approach, investing for the future. Okay. Other things that you're going to get available on the markets as well are things like indices, commodities, okay, currencies, bonds, derivatives, a load of different types of things. And we'll go into detail with them shortly, okay. OTCs again, okay. That's a completely different playground. Okay, now here's the thing: the stock markets, there's shares and all those different types of things that we can be traded. It's a highly regulated marketplace. Okay, so to give you an idea of how regulated it is, with something like the JSE, the Johannesburg Stock Exchange, okay, it's probably one of the world leaders in terms of regulatory body, for shares and companies and those type of things, because they are extremely, extremely strict. Um, the nice thing about South Africa, though, is the fact that they're also anal about the financial industry. Okay, sorry for the wording and that kind of thing, but guys, I'm just giving you the truth over here. Okay, this is why I prefer a lot of brokers to be registered with the Financial Services Board in South Africa. Okay, because they will cut your license if they sniff anything wrong, and you will not be able to offer your services to your clients and that kind of thing. But it keeps companies on their toes, on their edges, and making sure that they're always operating above board. Okay, so that's why I prefer that. And I mean, the FSB does some brilliant work and that kind of thing. So that's why I'm all for it. But with the JSE, basically, there's, if you think about it, it's a place where investors come together. But why do companies list on the stock market? That's the big question. Think about it. There's three ways that a company can go about in order to get a big cash injection if they need to expand quite vigorously. Okay, whether it's around the world or just expanding into every corner of their own country and so forth. Number one, they can go to the bank. When going to the bank, there's two problems that we've got. Number one, you've got to pay the money back. Number two, you're paying interest on that money. So problem is the money's never yours, firstly, and you've got to pay extra upon that. So not really the best type of option to go for. The other option is creating what we call a bond. I think what I'm going to do is let's just go to the next slide so you guys can see exactly what's happening. Okay. A bond, not James Bond 007, okay, but I'm talking about a company or government bond. Okay. Now every country's got one, in South Africa we've got the RSA retail bonds. There's many different types of ones, no matter where you go to. Okay. But what I need you guys to understand is that a bond, okay, is basically the exact same thing as a loan. The exact same as the loan from a bank. But the difference now is that instead of lending money from the bank, the company or government lends money from the public. So sad part is you still have to pay all the money back, and you still have to pay interest. But the big difference between a bond and a loan, okay, is that with a bond, okay, a government bond or retail bond or anything like that, the company or the government controls the interest rate and not the bank. So it's normally a cheaper option for them to go via that route than lending money from one of the institutions. Okay. The third option and the best option tends to be listing on the stock markets. Okay. Because there you keep all the money. Because you're selling off portions of your company to other investors. If you want to, you can at a later point buy it back. Okay. But the beautiful thing is you can grow that investment to quite a big size. Okay. The beautiful thing is, like I said, the money is yours. You can do with it as you'd want to and that kind of thing. Okay. But obviously in a responsible way. Because yes, being able to get those perks, you're going to be pushed to jump through hoops as a company. Okay. There's going to be a lot of red tape and flack that you're going to need to get past. You're going to have to give out your statements and so forth publicly every single time. Okay. There's going to be general meetings. You've got to have internal structures set up in a proper way, all to make sure that the company is transparent so that any of the investors that are on the stock exchange can feel safe to invest in any of the companies listed on there. Okay. So you can see that the JSE or any stock market for that matter is quite a very highly regulated market. Okay. Right. Now, like I said, the different types of things you get there is you get your shares. You can only make money when it goes up, though. If it goes down, I'm going to lose money. Okay. Shares, basically, I'm going to have to put down the full purchase price as well. So if I want to buy, let's say, a Volkswagen share, that's going to cost me, let's say, $70 per share. I need to put down a full $70 in order to own that one share. Okay. Then I get known as a shareholder. I'm part owner of the company. I've got one voting right due to the fact that I've got one share. So at a normal general meeting in the company, I can then go and throw my one vote. Not that it's really going to matter much, okay, because there's going to be loads of people with more shares, meaning they've got bigger weights in the votes that gets made. Okay. Now, the other thing is that with shares, being a shareholder, there are a couple of nice other perks that comes with it. Okay, so you're not only part owner of a company, that kind of thing, but certain shares actually allow paying dividends. Okay, and dividends is a very, very nice little extra income that a share can generate. Now, here's the thing: it's not your right to receive a dividend. Okay, I don't know why people have got that perception. It's just so idiotic. Okay. Um, but a company has the right to decide whether they do or do not have to pay a dividend. Now, what is a dividend? A dividend is like a little good faith thank you payment that the company makes when they've received a lot of profits and that kind of thing. And when I kind of just thank their investors for investing into their company, they will basically set out a payment, okay, per share. So obviously, the more shares you've got, the bigger the dividend payment's going to be. Okay. And those tend to happen. It depends from company to company. I mean, a lot of companies don't do that. Okay. No company has to. But then you get quite, it's especially the blue chips, the big boys. Okay. They tend to either pay annually or biannually a dividend to their investors. So for a long-term portfolio, having quite a couple of shares that actually pay dividends is quite a nice one to go for because it's a solid extra income that gets generated while you're just leaving those shares to grow over the long term. Okay. Indices, what is an indice? An indice is nothing more than a measuring tool, okay, for a economy or sector within the economy's growth or strength. Okay, it's nothing else. Now, what is an indice? Give me an example. Well, Dow Jones, it's the industrial index in America. Okay, FTSE 100. Okay, that's the overall index for the UK. The Aussie, it's the all share index in South Africa. Okay, an index is a listing that groups a portion of the market. So something like the S&P 500, Standard & Poor 500, takes the top 500 performing companies, okay, in the US, and the average growth between them gets depicted on that chart. Okay, so to give you guys a bit of a better idea and view, if I had to create an index from scratch, we'd obviously have our chart, okay, and that section, that axis would be time-based, okay, and obviously that axis would be value-based, okay. It's the setup of any tradable chart, okay. But let's say we're going to start at something like 1,000 points. That's the thing. You need to remember that an index is always measured in points. Now what we're going to do is we're going to create what we call the DJV index. Okay, we're going to take the average growth that all of our live traders make and depict it on this chart. So let's say Monday starts, okay, everybody's trading. We had some big winners, big losers, had a lot of different results and that kind of thing. And on average, we had a loss of 1% overall. We'd see a drop of 1%. Okay, well, let's just do it like that. There we go, a drop of 1%. The next day, we get the average and we've got a growth of 5%. Okay, just gets depicted on that. Then we get a growth of 3. Then we get a drop of 2. Then we get a growth of 4. Then we get another growth of 2. Then we get a growth of 1. Then we get a loss of 3. Then we get another growth of 5. Okay, and so it continues. That is what you're seeing, being depicted on any index chart that you're looking at. It's the average growth being compared to the previous day the entire time. Okay. So obviously, whenever an index is going up, it's a show of good strength for that particular section. If it's going down in value, then we know it's doing quite weak and poor. Okay. So index is nothing more than a measuring tool, actually. Okay, so how do we make money off something like that? I mean, if there's no monetary value attached to an index and it's only a points-based system, how can we make money off of it? This is where the brokers come in. Okay, the big thing to understand is that broker-wise, okay, the brokers will set the conditions, the terms, payouts, and the values themselves. So on the broker, depends from broker to broker, they will set a minimum risk per point as you're trading it. So normally when you're going to be trading any type of index and so forth, let's say you're going to be looking at the Nifty 50, okay? They might tell you that it's going to be a minimum of a rupee per point or $1 per point or whatever, currency they want to attach it to. They normally tend to do it in the currency of the index itself. Okay, so something like the Dow Jones would basically be done and matched up with a dollar, where something like the FTSE would be done with a pound. Okay, where something like the French CAC would be done with a euro. Okay, so those are all the different types of links that you can get, but the broker allows you to choose and set a value with them. Okay, per point, so that let's say you're setting it to $1 per point. If the index goes up by 100 points, you've made $100. But just like that, if it goes against you, okay, you're going to lose $100. Now, commodities are basically your stuff like gold, platinum, palladium, silver, all those different types of things. Okay, it's physical assets. Okay, currencies, that's our normal interest rate changes, and that's euro versus US, pound US yen, US rand, all those different types of things. It's all just interest rates compared to one another. Okay. Bonds, we've dealt with that. Okay. Now, like I said, there's different ways for a company to basically list on the stock market and that kind of thing. Or well, to get a cash injection, and listing on the markets is one of them, but a bond is another method. Okay. Now, one of the thing I need you to understand about bonds, though, especially government bonds. Okay. Why does a government need to create a bond? Getting a bit serious now. Why does any government need to create a bond? Okay. Here's the thing. When a government needs a cash injection and they're not getting enough money from tax, the bond is the next best thing. So the government is lending money from the people that they need to pay back. But they're lending money which they don't have. How are they going to pay that bond back? I mean, if they're not getting enough money from tax, how are they supposed to service those bonds? Interesting question, isn't it? Okay. So let's get down to a bit of nitty gritty here. What I need you guys to understand though, okay, is that the government applies, and here's the thing, it's not a thing that is set to only a particular zone or anything like that. Okay, that's what I need you to understand there. This is something that happens all over the world in basically almost every single country. Okay. The government kind of minimizes the amount that they need to pay back by controlling one important thing, lessening the value of the bond that they need to pay back by applying what we call inflation. Now, what's inflation? Inflation is basically the percentage of value that your monetary currency drops by year on year. This means that if inflation is sitting at 6%, if I've got $100, okay, next year it'll only be worth 94. It's $100, but I can only buy $94 worth of goods, okay, because of the effect that inflation has had. Okay. So inflation links to the monetary decrease of your buying power. Okay. Now, this is the funny little thing. These figures the governments give and so forth for inflation, they're all a lie. Okay. It lessens the effect that they need to put into bonds and that kind of thing to pay them back. Okay. And if you only need to pay back the bond in 10 years' time, you've got 10 full years to drop the value that you need to pay that bond by as much as you want to. Okay. The sad fact is that when looking at things like inflation, the governments paint a beautiful picture for everyone. They've got inflation targets and all this type of things they want to keep to. In South Africa, our inflation target is between 3 and 6%. Okay, we've been sitting just with like a couple of points just above that 6% level. But that all is a lie, though. Okay, and it's the same way within every single country. Think about it this way: if people knew what the true inflation figures were, what do you think would happen? Let's say, I mean, think about it this way: what happened with Zimbabwe? Okay, when their inflation went mad, people started raiding shops and stores and those kind of things, and it was basically havoc. Okay, and governments need to control that. They need to stop people from, getting to that point. So sometimes what you're going to find is, they're going to lie. That's what happens. Yeah, not the proper thing to do though. But hey, it's one of the unfortunate things that we've just got to accept. As long as we know these things, we can play to our advantage. Okay, but there's a little term that I call personal inflation, which reflects more truthfully the type of drop in value that your money has got. Think about it this way. I mean, we've seen it happening now these past couple of years, especially since the recession and that kind of thing. I'm still thinking we're going to hit a heavily big recession at one or other point in time, a world recession. I've been saying it a couple of years ago. The only problem is I don't know when. But the problem is that there's a bubble being created and it's been inflated. None of the solutions that are being put into place is actually something that solves anything in the long term. Okay, it's only short-term solutions to solve their own pockets and that kind of thing. So yeah, I'm not trying to be a predictor of doom or anything. I'm just saying be aware that we might have some big drop-offs happening at one or other point. Okay, we don't know exactly when. Um, that's the only thing. Okay, but just be aware that anything can happen. As long as you know that, you can prepare for any such situation. Like I said, just be prepared. That's all. But basically, think about it this way. Okay, how many times in the past couple of years have you gotten an increase? To those of you who did, well done. Okay, got some nice bosses and that kind of thing then. Okay, most of us, we've been sitting with the same paycheck year in, year out. Now, how much has petrol and gas gone up by year over year? So how much are you paying for your travel expenses up and down to work, picking up the kids to and from school? Okay, they keep on increasing, yet your pay doesn't. So that leaves you with a smaller chunk to fend yourself with through the month. Now, in South Africa, unfortunately, we're being hit with a double-edged sword, actually. This happens all throughout the world, but we get targeted with a couple of other things as well. But now, here's the thing. You're paying more for petrol, okay? You've got less money to use now at the end of the month. But it's not only you that are feeling it, okay? Delivery companies are feeling it. Farmers are feeling it, okay? So delivery services have to push up their fees. Farmers have to push up their fees and those type of things, or they have to push up the prices, okay, for their produce to make sure that they can cover for those expenses that went up. Now this gets flung over through to the retailers. Now the retailers are paying more for the produce and for delivery of produce and that kind of thing, okay, and they have to roll that over to you. Okay. This is why we keep on seeing that when something as simple as in petrol increase or in gas increase happens, it's got this knock-on effect like dominoes towards the rest of the web, I would say, okay, within the country. So you're going to notice that transport gets affected, retail gets affected, even the medical side and so forth, okay, produce and so on, all of that gets affected because everybody in one or other way or method uses gas or petrol, okay? Now, like I said, in South Africa, we've got a double-edged sword type of thing. Unfortunately, with us, we've got a sole regulator supplier in terms of electricity, which is what we call Eskom, okay? Um, Yeah, load shedding, a lot of fun. Anyway, we tend to get quarterly increases and they want to push it up by about 25%. I mean, if they can get that every quarter, they'd be smiling. Okay. But the problem is now the public has to pay for an idiot's mistake at the company. Okay. That is what is not right for me. I mean, if you want to pull fat, big bonuses and that kind of thing, do your job correctly. But now to expect the public to pay for your mistakes is just idiotic. Okay, but that's unfortunately what we get. You get that in every single government. Okay, fat cats wanting to sit and just pull money without really doing anything productive. It's not the right way to go about it. Okay, we need to change people's lives. We need to help one another. Okay, now that knock-on effect. Okay, so now you're paying more and more for electricity as well, quarter to quarter. Okay, the issue with that is now you're being hit doubly. Okay, so you're paying more for electricity as well. Okay, you might need to put your heater on for less of time now. Okay, in order to push the electricity through to the end of the month. Okay, but in the end, you're going to notice you're going to pay more. Okay, other problem as well is that this is another knock-on rollover effect. Same thing with water supply. If you're going to get charged more for water, everyone else is going to get charged more for water as well. Okay, it's one of those unfortunate things, and it's got this knock-on effect where it's not only one thing that gets affected, but it's quite a huge pool of different things that are being affected by this. And in the end, your actual figure for inflation is something much, much closer to over 20%. That's sad. Okay. So where do they come up with these 4%, 3%, 6% figures? What did I say earlier, guys? It's all a lie. Why? It's to control people. It's to make sure that people don't overreact, they don't start causing riots and anything like that. Okay. Think about it this way. If you don't believe me, go and check how often the formula for inflation gets changed. No, that's quite funny. Okay. Why would they need to change it so often? It's to play around with the numbers to make it look good. Okay. It's pulling the wool in front of everyone's eyes. The fact is, once you know these things, okay, at least you know how to play the ball in your court to your favor. That's what we're going to be kind of just making sure we get, we understand, we kind of use to our potential and favor. Okay. Now that I've handled all of that and that kind of thing, here's the problem we're sitting with then, guys. We need to make sure that we can gain at least more than what our personal inflation is with the growth we make within our money. This is why a normal savings account does not work. This is why an annuity does not work. Okay. I'm not saying never have them. I'm saying plan your portfolio smartly so that a bulk of your money is doing proper growth and work for you. Okay. Instead of you losing out and decreasing the value of your investments by just leaving it and inflation eating in at it. Okay. Like I said, because of that inflation factor, I mean, if you're just going to stuff your money under a mattress, that ain't going to help you as well. Okay. The value of that is just going to get less and less and less as time goes by. Okay. Now, derivatives is another collective term for anything that can be traded and being made money off of, whether it's going up in value or down. Now, how can I make money on something that is falling in value? This is the beautiful thing about derivatives. This is why I trade derivatives. Okay. Now, a derivative is like, think of it as a type of instrument. Okay. So you get shares and you actually get a derivative of a share. The difference is that with the derivative, it's not a physical unit. In other words, if I am going to be trading the share ABSA, okay, I will be a shareholder, I will have voting rights, I can gain dividends. But if I'm going to be trading the derivative of ABSA, firstly, I'm not going to be a shareholder. I'm not going to have dividend rights. Okay, so I won't be paid dividends or anything like that. Okay, even though the others are, because I'm not in possession of the physical unit. A derivative is nothing more than a piece of paper. It's a contract that is linked to the underlying value of the asset. Okay, so the derivative contract of ABSA would be linked to the actual value of the physical asset of ABSA. So if the share price goes up, the derivative contract's value goes up. If the share price decreases, the derivative contract's value decreases. The beautiful thing is that with a derivative, I never need to put down the full payment as compared to a share. I only need to put down what we call a margin. Okay, it's like a good faith deposit. Okay, so for playing the contract, I only need to put down anywhere from, and it normally works out to roughly about 10% of the actual value. This means that if I'm going to trade $1,000 worth of ABSA shares, if I'm going to go the derivative side, I'm only going to need to put in $100. I'm still left with $900 that I can utilize in any way I'd want to. And I'm still going to make the same growth or losses that the person with $1,000 ABSA shares can get, because I'm exposed to the same amount of influence. I've got the same number of contracts that they've got as shares. Okay. So you can see already the difference between shares and derivatives is the fact that I need to put down less money firstly, okay, in order to get the same amount of units. And the other difference is the fact that I can make money whether it's going up or down. Again, how do I make money when the market goes down? Very simple. Retailers do this every single freaking day. Okay. Say you want to go and, buy a dishwasher. Okay. Had enough of, getting your hands dirty in the zinc and that kind of thing. So thought, okay, let's make things easy, get a dishwasher, so forth. So you go around to the stores, find one that's on special. It's going for, let's say, $500. Okay. Nice, good quality unit and so forth. Probably make you a cup of coffee or something as well. But basically what happens is that you get there, you want to purchase the unit, you're thinking this is good value for money. Okay, so you're saying, okay, I'll buy that. Now, the shop assistant tells you, okay, well, sir, all good and well. We'll give you that unit. Only problem is we haven't got stock at this point in time. But we can make sure that we set the price nice, we get the sale done and that kind of thing, and we'll deliver within 2 weeks. All good. So what happens here? Okay, you're buying something, right? But there's nothing there. Okay, so what is the shop doing? They're selling you something that they haven't got, and they're gonna give you that unit later on. So they make an income with the $500 you give them for the unit, for the sale, and you expect the unit now within 2 weeks. They've got 2 weeks now to go and source the unit, okay, from the supplier or even from another store if need be, okay, at a cheaper price. So let's say they go to the supplier and they can pick it up for $300. You see that that is a drop in value from 500 to 300, right? That drop in value made sure that they made a profit of $200, because what actually happened? All that happened is they sold first and then they bought, instead of buying and then selling. It's just the reverse action. So that's how we make money on a falling market. We sell first and then we buy back what we sold at a cheaper price. So when we're selling a contract, a derivative, you can't do this with physical units, okay, because you can't sell something that you haven't got. But when it comes to derivatives, contracts that are linked to the physical units, I can sell them off by borrowing a contract from the broker. That's what the margin payment's for. okay, selling it off at a high price to another investor. And all I need to do is I need to replace the contracts that I borrowed from the broker by buying it back cheaper from someone else. The broker's got his contracts. He's happy. I've sold my contracts, okay, for let's say $1,000, and I had to buy them back at let's say $800, okay, and then I replaced it. That's a difference of $200. It's $200 of profit for me, okay. So that's how we make money on a falling market, okay. Now, most of the above on the stock market side can only be traded in a bullish direction due to the fact that they are physical units. Only the derivatives allows us to trade up or down. Now, on the OTC side, okay, the over-the-counter markets, this is one of the market types that we get within Forex trading, okay. There you'll only trade derivative contracts, and that's what we're going to be using. We're going to be using OTCs to be trading with, okay. This means that basically I could trade up or down on any instrument that I'm looking at, okay? And I only need to put down a portion of it. I can make the exact same growths, okay? I do not like waiting for a couple of months for a market to turn from bearish to bullish before I can start getting active. I want to make money whenever there's opportunity to make money, okay? That's why I prefer derivative trading. That's what we're going to be doing, guys. That's how we're going to be going about it, okay? Right. Now, remember how the wording was that I gave earlier? With the stock markets, okay, what we're going to be looking at is we're going to be trading against other traders, okay? It's a meeting place for like-minded investors to get together, to swap units between one another. So when you're trading on something like the stock markets, it means that if you win, someone else loses. Okay. Your orders are normally only taken if there are other traders trading at that same price, okay, for the same instrument. And then you normally get charged higher fees purely for the fact that it is a much higher regulated type of industry compared to something like an OTC. Okay, and those fees kind of, you've got your straight fees, you've got your IPLs, which is not the Indian Premier League. Okay, it's an investment protection levy. You've got your normal tax on all of those as well, that kind of thing. So you can see, and then you're still going to have your brokerage fee as well, okay, dependent on the type of broker you're going to use and so forth. But all these fees start adding up, okay. Now, with an OTC, here are the differences that you're trading against the broker. Remember what I said when you're trading against other traders. If you win, the other trader loses, right? So if you're trading against the broker, what does that mean if you win? Who loses? The broker. Now, why on earth would any broker open themselves up for that amount of risk? I mean, that's insane, isn't it? Okay, you're just opening yourself up for huge amounts of risks now. Well, for those of you who took a note of what I said earlier, you'll be smiling now and you'll be knowing exactly why. But the fact is, guys, if I had a couple of billion, I'd open up a brokerage tomorrow. Okay, we'll have to wait till Monday, seeing as we need a business day to be able to do it. But the fact is that it's one of your most lucrative methods of generating cash. Okay. Because here's the thing. How many people are successful on the markets? Ding, 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 ding. Only 10%. This means that the broker has always got a 90% chance on average to always win every single trade that's taken. I mean, with those odds, why not open up a brokerage? See what I'm saying? The other difference is that with an OTC, your order always tends to get taken because the broker is the counterparty. You don't have to wait for any other trader to fill that up. The broker fills it for you. Okay. And you charge smaller fees because of the fact that the broker is basically the main regulator on their own portfolio. They do have certain set regulations to fall under, you know, going with different types of regulators and so forth. There is an overall body that they need to correspond with. But okay, this is why I look for a lot of brokers that are registered as an extra with the Financial Services Board in South Africa, because they're also, strict with these companies. I mean, quite a lot of you know about what has happened with ACM Gold, one of the big brokers. Okay. Um, we do use their services. We've got another one, markets.com, as well, that we use. They're in the UK, but both these are FSB registered. Okay, it just gives our clients that added protection. ACM Gold, believe it or not, was actually banned in South Africa for the last 2 months. Their trading license was revoked. Okay, purely for the fact that one of their subsidiaries, one of their introducing brokers, in other words, not someone that works for them, someone that introduces clients to them, scammed a lot of people. Okay, believe it or not, it was a pastor at a church that ran a managed trading account, and people deposited money and that kind of thing, and he actually used their cash to pay for his own living expenses and that kind of thing. Okay, yeah. It's basically what happened with the story and that kind of thing. But yesterday, I think it was the day before, got an email. They've been given their trading license back. Everything's all clear on their side and so forth. But this shows you, this is the type of power that the FSB has got. Okay, they're a lot more stricter. Probably one of the strictest type of regulatory bodies when it comes to any financial board in the world. Okay, because they actually exercise the type of power where all the others just let them run. Okay. So that's why I'm so anal in making sure that we choose brokers that are specifically registered with the Financial Services Board in South Africa. Okay. Do not trust any broker as well that says they are. Go and do research on the FSB number, because you're going to find a lot as well. I mean, especially with the scams. I mean, you get one of these Philippine companies and so forth that do managed funds. And it's not that it only happens there. Okay, I've seen quite a couple from there. Well, when I do a WHOIS search on the site, you can see that it's been registered in the Philippines. The Financial Service Board number that they get is from New Zealand. But when you actually go and type in the Google number, or the number in Google for the New Zealand Services Board, okay, you see that the number has been given. The same thing happens in South Africa. A company gets issued a number, okay, and then they get approved for it or not. So they've got the number before they're even approved. And what you notice is, when you actually go on with the number that they give you on that site, so it looks all legit. But when you get onto the New Zealand Financial Services Board site and you just punch that number in, you see that they were never granted a license and they're actually banned from operating. But people do not do their due diligence. So here's the fact, guys: if you've lost money, and if you're going to lose money in any type of way in that, and because of those reasons, well, I'm sorry to say, but that's your problem. Okay, I'm making you guys aware of these things now. Okay, and I've got that firm belief that when people make mistakes, it's for a reason. Okay, you're there to learn a particular lesson within life. And it's very simple. If you can't learn the lesson at that point in time, you're bound to repeat that same mistake over and over until you actually learn from that lesson. Okay, so never see any of this as an extremely bad thing. Oh, it's the end of the world and so forth. Guys, it's a lesson. Get past it, get over it, learn from it what you can. Okay, but I am warning all of you in advance at this point in time, because I mean, I've seen it over and over. I spot these things a mile away. Okay, it's like walking and just smelling sulfur. I mean, it's the stench that just comes in. Well, something's not right. Okay, like I said, that's why rather, if you're unsure and you're looking, I mean, I don't mind you guys checking other things at all. Okay, I just don't want you to be corrupted in terms of your approach and that kind of thing, or get into a situation where you're going to lose money. Okay, so rather just check with me firsthand. If you are looking at going for another opportunity and that kind of thing, just check with me to see whether I think it's legit. Go with it, that kind of thing. Oh, no. Rather keep away, stay away. This thing is only going to cause trouble. Okay. Really, guys, it's. I don't want any of my clients to step into dangerous territory in that sense. So, like I say, guys, my main goal is to make sure you guys make money. I don't want you to lose money. Okay. So don't try and push yourself into something that you're not ready for. Okay. Right. Now, like I said, we've got the OTCs that we looked at now. Now all we're going to do is we're going to start looking at a couple of different types of Forex brokers that we get, okay, or derivative brokers. OTCs is one of them, okay, but there's quite a couple of others that we get. There's two others. There's ECN, which is Electronic Communications Network. There's STP, which is Standard Trade Protocol, okay, and those two are very similar to one another. Okay, it's just the communication between the networks that differ slightly. And remember, with an OTC, okay, the beautiful thing is that you can never lose more money than what you've got in your account. You know, a lot of people used to think, oh, but you know, when you trade that kind of thing, you can lose your house, you can lose this, you can lose that. Yes, you can. But if you understand the differences between the different types of brokers, you know how you can get affected by them. Now, here's the thing. This is why I like going with OTCs a lot of the time. But I mean, I'm not going to lie. I've got so many different types of broker accounts, and it just depends on which broker it is, which system I'm running as well. Okay. But I've basically got each one of these accounts at least once. Okay. Nice thing is that with an OTC, you can't lose more than what's in your account, because the fact is the broker, because they are the counterparty, they're the one that is going to lose when you win. And when they win, you lose. So they've got no guarantee at all that when you lose, if you're going to lose more than what's in your account, they've got no guarantee that they're going to get that money out of you. So why get to that point at all? And they'll just cut you off before you even get to that point. Okay. So you'll have a couple of dollars or rands or so forth still left in the account. Okay, not going to be a lot, but the fact is you can never lose more than what's in your account. Okay, that's the beauty with trading with an OTC. So if you're worried about losing more than what you've got in your account, an OTC is going to be a good one to go with. Okay, ECN, there you are going to be, and same thing as with STP, you are going to be liable for any money owed if you do go into a deficit within your trading account, because you're not trading against the broker anymore, you're trading against other traders. This is the difference between ECN and STP compared to OTC. The ECN and STP markets is where you're actually trading against other traders, because you're going to be trading different types of bank rates and quotes against one another. Okay. So be aware, you can lose more than what you've got in there. Remember the whole franc drop in the beginning of the year, the interest rate change that was made, right? The huge effect that had on the Forex markets, okay? Now, what that caused basically is the biggest moves within 7 years that we've seen within the Forex markets. There were a couple of billionaires made, and there were a couple of billions that were lost as well. Okay, you were either on the right side of the day and that kind of thing. Like, I didn't get affected at all by that because I'm not in any franc pair, you know. Now, the big thing is basically is that especially with FXEM, they were in the news as well, and one of my accounts is with them as well. Okay, they lost a lot of money and they owed people money, because here's the thing. Okay, the people that won needed to be paid, but they needed to get that money from the people who lost, because you're trading against other traders. They went into a deficit. Now they can't get that money. So they ended up owing $20 million. Now they had two choices. They could either go and, you know, get the money from the people by sending them, you know, summons and those type of things and getting the lawyers involved. But what are the costs that are going to be incurred by doing that? Okay, they're only going to be in a worse of position, because the fact is they don't even know if they're going to get the money back. The other option was taking a bailout. I mean, there were a lot of people kind of running around like a headless chicken, and screaming, going mad. I knew that FXM is one of those companies. They're just too big to fail. And funny enough, that Friday when all those news came out and that kind of thing, and everybody, kind of started running around saying, close your accounts, take your money out because you're never going to see it again, that kind of thing. I knew everybody's just exaggerating. You're always going to get some of those. But if you think about it logically, you'll know that there's no way they'd be able to do that. Okay. It's only going to cause more issues. And that very next Monday, they actually got bailed out by another investment firm with $30 million. Boom. Problem solved. So what did they do? They told all the clients who were in a deficit, okay, don't worry. Okay. We're not going to hold you liable at this point in time for any of those things. Okay. Your debt's been cleared and so forth. You can continue trading if you want to, that kind of thing. Done. Okay. So here's the thing. Like I said, with an ECN and an STP, you can lose more than what you've got in your account. Be aware of that. It's because of the fact that you're trading against other traders. Okay. When you're trading against the broker, you normally don't have that issue because the broker is going to stop you from getting into that position and getting them into a troubled spot. Okay. Now the differences is normally quite easy to spot when looking at the trading platform. An OTC will have what we call a charge or a spread that is fixed. It always stays the same. Whereas on an ECN and an STP, those costs will be variable because you're being quoted from different banks, different institutions all the time. Okay. And that's when you know you're trading against other traders. So when you've got a variable spread or variable cost, it keeps on changing. You know you're trading against other traders. But when that charge is fixed, that's normally when you're trading against the broker because they're the one controlling those rates and so forth. Okay. Right. Guys, we've basically hit 10 a.m. Okay. So what we're going to be doing now is we're just going to be taking a quick little break. Let's get cracking at about 25 past. Okay. So that we can get running at least at, half past. Okay, 10. So let's take about a 20-minute break and we can get back and, continue from there. If there are any questions, that kind of thing, guys, you can either email me or use the group chat feature. Okay. But other than that, I will see you guys in, let's make it, like I said, about 20 minutes. Okay. So we're gonna start this thing at about 25 past 10. So go and grab a bowl of cereal if you haven't already yet. Make a sandwich and so forth. Grab a cup of coffee. It doesn't matter. And I'll see you guys in about 20 minutes time. Okay. Chat soon. Okay, so I hope that most of you are back at this point in time. Okay, so let's get started with the rest of the session. Okay, now hopefully all of you, kind of just freshened up a little bit, maybe grabbed a cup of coffee and so forth, all good. And now we can start with getting into the nitty gritty of everything. Okay, so what I want to focus on at this point in time, okay, is we're going to start looking at the different types of trends that the market gets into. So now we're starting to get into the fun part of everything. Like I said, I've used the first part basically to do more of a, how to say, a scolding almost of certain aspects and what you need to expect and understand about the financial markets to just get the right type of mindset for it. I guess that you kind of know what you're getting yourself into and you've got a feel for it, when you start with it. Okay. What I'm going to want you guys to try and do as well is at least from Monday onwards, I need you all to start taking some trades on the MetaTrader platform. I don't care if you don't know how to place a buy or a sell or how to place a stop or a target. None of that matters at this point in time for me. We're going to start getting a lot more, I would say, strict on those aspects once we start with the second session. At this point in time, it's all about just getting a feel for the platform, getting to know what sits where and those kind of things. Go mad. You're going to get questions. You're going to have many of them. That's what I want happening, okay? Because that's where the learning process starts, okay? So from Monday, start taking some trades and going mad with it. But in the end, what we're going to be looking at is we're looking at trend trading. Okay. And trend trading is used to take advantage of trending markets, whether it's moving up or down in trend. Now, trend trading is basically the aspect of making money with the markets leading in an overall direction. Okay. So by identifying a trend, we can identify where most of the momentum of the price is heading towards. And based on that, we decide whether we buy or sell. Okay. Now, one of the key factors in making money in the markets comes down to being able to spot where momentum is building up or where it is heading to. Okay. If you can do that, then you're going to be basically being able to make money off of any point almost. That's the beauty of it. Okay. Now, the chart basically goes two ways, either up or down. Now, when the chart is moving up, we refer to it as a bullish moving market. It's an upwards trending market. When it moves down, we refer to it as a bearish type of market. Okay. But there is a third one as well. That is what we call and refer to as consolidation. That is basically sideways movement. In other words, price is indecisive of what direction it wants to go into. Okay. That is a very, very difficult point for any trader because you need movement in price in order to make money. So if there's no movement, there's no money to be made. So you're going to see that consolidation periods are the killing periods for any trader's account. Okay. Now the question is, how do we identify these trends? That's where the tricks come in. A bullish market makes higher highs and higher lows. A bearish market makes lower highs and lower lows. And then a consolidation period doesn't make any new significant highs or lows. It basically trades within what we call a range. Now, I'm not talking about a cooking range, okay? I'm talking about support and resistance. So it's like price is fluctuating between two key price points, and it just sticks within those 2 points. Okay. So it's not really breaking any new highs or breaking any new lows or anything like that. It's more or less a jitter of price towards a sideways direction. Sometimes it could be slightly down, sometimes it could be slightly up, but there's no real big movement happening. Okay. And those big movements are tricky ones to try and make profit off of. So we normally tend to try and stay away from those sections. Okay. And we only try and tackle the market once there's good momentum behind it. Think about it this way. What's going to be easier to swim? Okay. What'll get you swimming 100 meters in a stream faster? Swimming against the flow of the water or with the flow of the order? It's going with the momentum. Okay, that's going to be the easiest. So why do you want to go against the momentum in the markets when trading? Okay, now I'll be showing you guys techniques and tricks that we utilize. And my main system is basically a system where um, I actually do trade solidly on counter trends. In other words, I trade against the momentum, but there's specific layouts and so forth that we've got for those. Okay, so there's specific setups we look at in order to determine whether it's going to go or not. I still always try and identify the direction and the entry the same way as that I'm going to be teaching you guys. We just approach it in a different angle. That's all. So there's always the same set of rules that we follow. Okay. So in the end, what you're going to want to do is you're going to want to determine the direction of the trend, where the ultimate momentum is heading to, and then target your positions in that direction. Okay. So let me quickly show you what a bullish and bearish section looks like. Okay. A bullish section is where price starts going up, comes down, makes a low, goes past the previous high point, comes down, goes past the previous high point, and continues going in an upward cycle like that. So you can see that that is what we refer to as a high. It's a higher high and another higher high. Then we've got a low point over here, a higher low, and another higher low. Then we get the market going in the other direction where it starts making a lower high compared to the previous. Okay. And it starts making a lower low as well. Okay. And it continues taking that direction. Now, consolidation is basically when we get that point where it starts doing that. It goes into a channel and it's not really making any new significant highs or lows. It could then just break the channel and then continue in a direction again. Okay. The market constantly does this. It trends, then consolidates, then trends, then consolidates, then trends, and then consolidates. Okay. So hopefully that gives you guys a nice insight into the type of movement we're going to get. I'll show you guys a chart close to the end of the session as well, so that you can see exactly how price runs and reflects and that kind of thing. We're not going to be seeing live pricing today, unfortunately, because it is weekend. Therefore, the markets are closed. Okay, would be a different story if obviously the markets were open on the weekends, because then I'd probably be trading most of my weekends. You're going to notice trading is highly addictive as well. It's like a drug. Okay, it's insanely fun once you get the hang of it and that kind of thing, and it's a constant challenge of your skills, and that's what appeals to me within the trading markets. Obviously, I enjoy the emotional factor that comes into play with it as well. Okay, but okay, getting back to our points now. Okay, a bullish market is a market that moves upwards, whereas a bearish market is one that moves downwards. Okay, and what I want you guys to understand as well is that we only kind of get into the market once we've identified an established trend. This is why we will never ever be able to get in right at the turning points. Okay, so let's say this is a bullish market that started at this point here. So we've obviously had the chart, coming down first and then it goes up. Only once it passes that point. Okay, so we've got a clear two higher highs. There's another high there, but it wasn't passed. So once we get to that point only do we get a confirmation normally that this is a change in trend. So we only start trading it basically from this point onwards. Okay, so from here onwards we tend to trade it. We're never going to catch that first section over there, just as with the change of trend for the downwards move. We're never going to catch that first section there. That is the problem that most people make. That's why a lot of people lose money, because they try and predict these turns so that they can get in as early as possible, okay, and make more money. And it's all emotional driven decisions. If you're going to try and do that, the market's going to catch you out over and over and over. Okay, so forget to try and aim for getting in right at the bottom and getting out right at the top, or for a sell to get in right at the top and get out right at the bottom. That's not going to happen. Okay. Another few things I just want to clear up with you guys is I want you to kind of just get used to the different wordings and so forth that's going to be used within trading and so forth. Okay. Now we know we've got two directions. We've got bullish and we've got bearish. Okay. And what you're going to hear trading term wise a lot of the time is when we're looking at a bullish section, it's an upwards moving chart. Okay. We tend to execute what we call a buy to enter the trade, or we're longing the chart. It's a long position that we're taking. That's what we refer to as the entry that we're taking. So obviously when we're in a bearish trend, we tend to sell, okay, or we short the position. Okay, so when I'm talking about selling or shorting the chart, I'm making money in a downwards direction. And when I'm talking about a bullish chart, we're going to try and buy or long to make money in the upwards moving market. So all you really need to know at this point in time, okay, is that whenever you want to make money in an upwards moving market, you're going to execute the trade with taking a buy or longing the trade. To make money in a downwards moving market, you're going to execute the trade by taking a sell or shorting the market. Okay. Right. Now, another little thing. Remember how I said that consolidation periods, okay, are probably the worst section for any trader because that's just where we're going to start losing money and so forth. Okay. What I want you guys to actually do is to start falling in love with consolidation periods. Now, why would I say that? Okay. I mean, I just told you guys that that's probably the most dreaded part for any trader. There's no money to be made within any sections like that. So why the heck should you fall in love with those sections? Here's the thing. Remember how I said that the trick in making money within the market is about being able to spot and identify momentum? Now, consolidation is a nifty little trick where you're able to spot a buildup of momentum occurring. Think about it this way. See consolidation as a coil or a spring. Okay. So we'd basically have a spring. Okay. And if I've got two sections covering each end, okay, what do you think is going to happen? Okay. Once these sections move closer to one another. Okay. So imagine it's my hands taking the ends of this coil and I'm starting to squeeze on it, putting pressure on this coil, okay? And the coil starts getting smaller and smaller, and it's being compressed more and more and more, okay? That's exactly what happens when the market starts consolidating. What is consolidation actually? Consolidation is an indication that there is unsurety within the price in that particular instrument. So if price is moving sideways, it just means that the overall perception is one of unsurety. People aren't sure which direction this market is going to head into. And what most people tend to do then is they wait to see what the chart is going to do. This is really all that is needed in order to be successful in trading. You need to develop that patience, okay, to be able to wait so that the chart shows you what it's doing and only act on it then. If you're going to try and predict what the chart's going to do, it's only going to slaughter you, okay? Now, the longer this consolidation goes, the more this pressure on this coil starts building up, and it builds up more and more the longer it continues. So everybody is now sitting on the edges waiting for something to happen. And what do you think is going to happen, when this coil is basically squeezed together, okay, at the top and the bottom? What do you think is going to happen when I remove that top section? Exactly. The coil is going to shoot up. What do you think is going to happen if I remove the bottom section? The coil is going to shoot down. Okay. So that's exactly what happens within consolidation. We get this buildup of pressure happening. Okay. More and more people are waiting and waiting and waiting. And as soon as it breaks into a particular direction, either up or down, more people are seeing that, hey, wait, something's starting to happen. So they jump on. Those who are a little bit slower start seeing, hey, this has started moving, so let's jump on. And everybody starts jumping on one after the other. And that causes that momentum for the chart to move. Okay. So consolidation is a brilliant little trick to try and identify a big move coming up. Okay. So what tends to happen is when consolidation gets broken, we tend to get a rally of price. The rally is nothing more than a fast movement of price into a particular direction. Okay, so what we're going to be doing is we're going to be using consolidation as a tool almost to identify that there's a buildup of pressure and so forth happening that we can take advantage of. Okay, and there's many methods and various ways of doing it. I'd say the biggest focus and key point at this point in time for you guys, okay, is to learn the different technical indicators as well as possible. The better you know them, the better different types of systems you can put together, the different types of approaches you'd be able to take. It just gives you more analysis opportunities. Okay. So you're going to notice, as we get deep into this, we take a very mathematical and scientific approach to the way in which we perceive the changes in the markets. Okay. And it's all due to the fact that we are basing all our decisions off of odds. Okay. If you haven't got a set of odds, why trade? Because you're trading in the dark. Okay. You're only going to be guessing and second guessing every single action you're going to take. Okay. And that's not the way to trade. I'm going to tell you now that you can kiss your money goodbye then. Okay. The confidence only comes once you've got the set of odds behind you, because then you've got trust within your system. That's why we do the whole process of back testing as well, which is what I'm going to teach you in session 3. Okay. And with that, basically, it'll clear up a lot of the doubts that you're going to have, because you'd be able to see exactly how a system runs, how it flows, what its normal average returns are like, and how many type of cycles it gets where it gets losers in a row. So once you start trading live, you can actually check if it still runs the exact same way. This means basically that whenever the market cycle starts changing and the system doesn't produce the same results anymore, you'd be able to spot this a lot sooner than most other traders. And for that fact, you'll be able to adapt a lot quicker to the new market moves, quicker than anyone else out there. Those are the skills that pro traders have. Okay, right. So like I said, you can see consolidation is going to be a brilliant little tool that we can use to identify, what's happening. Now, the formations that were done in the videos as well, okay, is a brilliant little example of how consolidation kind of works. Your double tops and bottoms, triple tops and bottoms, your pennants, your wedges, your flags, all of those are trend, consolidation, trend. Okay, flags, wedges, pennants, triangles, all those things, they're continuation patterns. So that's a build up of momentum. While momentum's running, it stops, confusion happens, there's sideways movements, which creates the flag or the wedge or the triangle, and then we get a break of those levels, and then price just continues to run. Now here's the thing, because something's called a continuation pattern, does not necessarily mean that it will continue in the original direction again. Nothing stops it from breaking out the other way. So keep your eyes open and wait for the market to show you what it's doing before you act. Because a lot of the times, again, people preempt. okay, and they try and predict that it's going to break. Let's say the market was trending downwards, now it starts consolidating. They predict it's going to go down again because of the fact that it's forming formation, okay. But nothing stops it breaking to the top side, and if it does, it can run. So if you're going to preempt, you're going to miss out on a move like that, okay. So wait for the market to show you what it's going to do before you make a decision, okay. It's the best advice I can give at this point in time. Another little piece of advice that I want you guys to kind of take to heart at this point in time, okay, is to make sure that when you're going to choose times and that kind of thing to trade and so forth, okay, make sure that you fit trading into your current lifestyle. Don't try and rearrange your current lifestyle around trading. It never works. Your lifestyle is always going to take privilege, according to that. So make sure that you can find a gap and so forth within your current lifestyle to fit trading into. If you're going to try it the other way around, you're only going to hit problems. Okay, trust me when I tell you that. And I've been working with hundreds, if not thousands, of clients already, and I've seen it many a time. Okay, so just be sure to kind of plan this out properly. I mean, if you need help with the planning, by all means, give me a shot. That's what I'm here for. I'm that sounding board for you guys to jump off of. Okay, you throw your ideas against me, and you let me analyze it and check it, and I'll let you know if you're on the right path or not. I'm basically just that guide for you through this entire process. Okay, each of you are going to go into your own individual little directions. Yeah. For me, it's just important to make sure that you're doing it properly. So I'm focusing more on the process than anything else. Okay. How you go about building a strategy, how you go about choosing what you're going to use, I really don't freaking care. Okay. Because it doesn't matter. The process is the important part. That's why we want to work with you guys for so long. Okay. You can't learn trading in 3 days. It's impossible. Okay, it takes time, especially with the skills that we're trying to teach you. If you're only going to try and do this in 1 day or 3 days, well, accept the fact you're going to be throwing money away. Okay, I've learned it the hard way many a time, over and over and over. Okay, I've done hundreds of courses and that kind of thing. It's only when I really started going about it my own way that I started seeing the results, and that's when the penny dropped for me. Okay, so that you need to develop something that fits your style. Okay, just simply copying someone else's doesn't mean it's going to work for you, because you need to be able to duplicate it the exact same way. If you can't, you're not going to see the same results. Okay, and then it's not that system's problem. It's your issues that are coming through on that system. So you need to find a system that fits with your style of approach. Okay, you're not going to know yet at this point in time, and it's mainly going to be dictated by the availability of time that you've got. That's going to be the main thing that's going to determine the style of trading that you're going to be using. Okay, but with the skills you're going to learn, you'd be able to adapt at any point in time. Okay, so if you do look at changing from end of day to intraday later on in the future, you'd easily be able to do that. Okay, that's the beauty of this. Okay, now we're going to be using technical analysis to time our entries into the markets and set targets. So our first job basically when looking at a chart is determining where the momentum is heading. Bullish, bearish, is it consolidating? And from that, we then use technical analysis to determine then as well when we're going to get into that position, okay, based on the direction that the market is heading in. Now we're starting to get into reading charts. Remember I said that, by the end of the session, all of you will be able to read and analyze candle charts, bar charts, and line charts. Well, that's what we're getting in now. And what I'm going to try and do is I'm going to make this as easy as possible to understand for all of you. Okay. Now, what we're looking at now is we're looking at candlesticks. This is a form of price being displayed. Okay. Now, when I'm talking about a candle or a bar or anything like that, I'm actually talking about a reflection of price movement within a particular period. So a candle can be called a period as well. So if I've got a 5-minute candle, it means it's a 5-minute period of price movement. So at the start of the 5-minute, okay, till the end of the 5-minute is the type of price flow that's going to be shown by a candle. Now, as pro traders, we will only be using candle charts and bar charts. The choice of which of the two you want to use is really a personal choice. Okay. Candle charts are visually easier to see on the chart because they've got the big fat bodies that you're seeing at the red and green bodies. Okay. Green meaning a bullish move, an upwards move, and red meaning a downwards move. Okay. Now, what we've got basically over here is we've got the big body, which you're seeing over here. And then we've got what we call these little wicks, which are pointing and protruding to the top and the bottom. Okay. Now, what happens is the big fat body of the candle represents the open and the close of price within that period. Okay. So, like I said, if it's a 5-minute period, the candle takes 5 minutes to form. We can set that period to be 15 minutes, 4 hours, 1 hour, a day, a week. It really doesn't matter. It's personal choice again. Okay. Now, on a green candle, which is an upwards moving candle, that automatically means that the open price is the bottom part. It goes up in value, okay, and then closes. But now there's these little wicks that we're looking at. Now, this indicates the highest or lowest point that price reached within that 5-minute period. Okay, so how would a normal candle flow? To give you guys an idea, okay, what I'd normally have is I'd have price opening and it starts fluctuating up and down, up and down, up and down, not really knowing where it wants to go, up and down, up and down, up and down. Okay, continuously doing this, going up and down until that 5-minute period finishes and it closes. So it opened over there, it closed over there, which means it went down in value. Because it went down in value, I just connect the open level with the close level, and because it's bearish, this gets colored red. Okay, that's how a candle is formed. As soon as it closes, it opens with the next candle and does the exact same thing, goes up and down, up and down, up and down, closes again, that gets filled, next body starts and trades. Okay, that is normal candle formation that happens. Okay, so that obviously is going to get colored red as well. But now you can see that within that period of open and close, it went past those levels as well. That's what the wicks are for. They show us the highest point and the lowest point that price reached within that period. Okay, now this is why I prefer candle or bar charts compared to line charts. The problem is a line chart only ever gives us the closing price. Nothing else. We don't know where price opened. We don't know where price went to as the lowest point. We don't know what was the highest point it reached. Now, if you think about it, why is that important to know? The fact is that price moves to particular points for a reason. And if you don't want to take that into equation, well, it's like throwing away half or more of the content that you need to base your decision on. Okay. I want to show you a little trick as well of why candles are so much better than line charts. Okay. Remember, only novices use line charts, and it's purely for the fact that they don't know about candles or they don't know how to read them. Okay, candles are actually very easy to read, and as I explained it now, hopefully you guys are picking this up quite nicely now. Okay, remember the big body just represents the top and bottom, or basically not top and bottom, but the open and the close. So if it's green, the open's at the bottom, closes at the top. If it's red, open is at the top, closes at the bottom. And then we get the wicks, the protruding sections out of those bodies. Highest point price reached within that time frame, lowest point as well. Okay, so all in all, with a particular price point, you can read 4 times more as information out of a candle and a bar chart compared to something like a line chart. Now, why is that important? Let me show it to you this way. If we had a candle that looked like this, what is that telling us? Okay, it's really doesn't matter what color this is or so forth, but let's say this was coming from a downwards moving section, and all of a sudden we're seeing this. What is this telling us? Okay, now we're looking at this candle on its own. Okay, remember, on a line chart it'll just be a point, and then we'll have another point that was drawn on the line chart, and those points just get connected, okay, to form the line chart. Okay, it really doesn't give enough info. But look at what 1 point candle wise can tell us. Okay, one candle. Here's the thing. Obviously, because this red one, it opened at the top here, started going lower, and it was pushed all the way down. I mean, look how far that wick goes down to the bottom. But then it got pushed way back up to that point, and it closed over there. So with that candle, what are we really seeing? Okay, price went down, correct? But it went down quite far. But in the end, it was pushed all the way back up. Okay, and this is what we call a hammer when looking at candles. So there's certain formations that you can trade as well. But the beautiful thing is that a candle can show us the psychology of the market behind a particular move. Think about it this way. We had a downwards moving market, and price was forced all the way down. But all of a sudden, then it gets forced all the way back to the top, almost to the same point as where it opened. What is this telling us? Who's in control? The bears pushing the price down, or the bulls pushing the price up? The bears try to exercise its control by pushing this down as far as possible. But in the end, the bulls took over, pushing price all the way back up. So this is normally a very good indication, okay, that we can get a change in direction happening. So what do? Well, I'm not going to buy now because nothing stops the next candle from going down. Okay. What we're waiting for is we're waiting to see whether the next candle, okay, actually goes higher. Because as soon as it goes higher and it closes, I'd enter on the next one. Okay, because that confirms then that the point has turned. Okay, guys, confirmation is going to be key within trading. Now, what is confirmation? Okay, guys, confirmation, you see when I go through the videos and those kind of things. Okay, when you go through the theory of videos, there's a section where I hammer on confirmation. Confirmation is so important, guys, that what I'd want you all to do is coming Monday, go to a tattoo parlor, okay, and go and book an appointment for a tattoo. Sounds silly. What I need you to do is go and get a tattoo done on the inside of your eyelid with the word confirmation. That's how important it is. Okay. Now don't literally go out and do it. Okay. It'll just be idiotic. But it's to kind of just stress the point. What I'd want you to be able to do is like every single time you blink, all I want you to see is confirmation. When you sleep, all I want you to see is confirmation. When you wake up, I want you shouting confirmation as the first thing when you wake up. Okay, that is the importance of confirmation. I mean, if this candle was still forming, what is confirmation? It means that the candle we're looking at closes and the new one starts opening. So in other words, what we are seeing forming has finished and set as that type of candle. So if this one went up, nothing stops this candle while it's still forming to go back down all the way and changing the look of this candle to something like that. Let me just quickly get that little section out of the way. There we go. Nothing stops it from changing to a candle like that while it's still forming. Okay, so you got in as soon as you thought this is going up, but then all of a sudden it starts changing direction and continues going down. Confirmation is the thing that will stop you from getting into false signals like that. Okay, again, if you're not going to wait for confirmation, what are you actually doing? You are predicting. We all know that no one can predict the markets, so it's useless to even try. Wait for the market to confirm and show you which direction it's going, then act. Okay, right, so this hopefully gives you guys a good idea of exactly, what candle charts and so forth look like and how they get formed. Okay, now the next one we're going to start looking at is what we call bar charts. Now, bar charts is the exact same thing as candle charts, the exact same. Okay, the difference, however, is that where a candle fills the open and the close to create the big fat body, the bar doesn't. Okay, the bar has got a little I would say a little notch to the left and a little notch to the right, and it's according to the position of those notches that's going to determine whether it's going to be a bullish or bearish bar. Now, the bars are actually quite easy to read. They tell us the exact same thing as a candle. So they show us the open, they show us the close, they show us the highest point that price went to and the lowest point. Okay, all the same info that we get from a candle. Difference, however, is now that to see the open, okay, instead of looking at the color, we look at the little notch. The open is always on the left side of the bar. Okay, so what we're seeing basically, excuse me, what we're seeing over here is the open because this is on the left side. So left side, there's the open over there. The right side is always where the close is. So it's the same as reading a storybook, okay, from left to right. Now, depending on the position compared between the two notches, okay, to the left and the right, is going to determine whether it's bullish or bearish. So if it opened here and it went up and closed, it's a bullish candle because it went up in value. Over here, we see the notch on the left-hand side being higher to the one on the right-hand side. So from left to right, it goes down. Therefore, this is a bearish bar. Okay. Simple enough, isn't it? Okay. So you guys think you've got this down a bit? I mean, I'm not even going to go into line charts. I mean, all of you should know a line chart at this point in time if you've seen any type of chart whatsoever. Okay, they're quite easy to analyze and see, and I mean, we've done them over and over in school. This is the first time you're probably seeing something like candle charts and bar charts because it is actually kind of a new thing in the Western world. We can thank Japan basically for the candlesticks. They used that to kind of reflect price changes within the rice trade a couple of hundreds of years ago. Okay, so they've been using it for years, and it's a brilliant little system. It's an awesome analysis tool. Okay, so thanks Japan. Appreciate the effort and so forth and that. Okay, but the Western world has been adopting this quite nicely. Like I said, it's an awesome little tool to kind of get a psychological insight as to what is most likely going on in the minds of the overall market. Okay, guys, there's only one thing that really moves the market. It's not news releases, it's not directors being hired or fired, or anything like that. The only thing that actually moves the market is perception. It's the perception of the masses. Okay. The problem we've got is that it's difficult to assess and gauge what the overall perception is. Okay. That's why we use technical analysis to try and derive that perception from out of the way that the chart is moving. Okay. But like I said, the only thing that really moves the market is perception. I mean, if we've got a disaster that has happened, if bulk of the world think it's a good thing, guess what? The chart's going to go up. Okay, same as if the bulk is going to think, it's going to have a detrimental effect, even though the analyst might think it's going to have a positive effect. If bulk of the people or perception out there is that it's going to be a detrimental thing. That's going to be the direction it's going to go in. Okay, but we can't kind of analyze every single person's perception out there. Okay, and that's what makes it difficult. And that's why we use the technical analysis to get a bit of a inside look into what that perception is, that psychology behind the move. Okay, this is the beauty of candle and bar charts. We can see so much more out of that compared to something like a line chart. So what I'm going to want to do now is I'm going to want to run a little test with you guys, and I'm going to want to see whether you guys have got this down. Okay, so all I'm going to do is I'm going to start drawing a couple of bars. Okay, and you can do this exercise at home on your own as well if you want to, and so forth. Okay, but basically this is just going to be a pure good little exercise to determine exactly, whether you understand this or you don't. Okay, so we've got our 6 bars here. We're going to always start at the top left, work our way to the right, and then we're going to go to the bottom row, and from there we're going to work left to right as well. But let me just number the points quickly. That's point 1, that's point 2, it's point 3, point 4. So I'm marking these, okay, to the left of each bar to indicate basically the sections that we're going to be naming. So I'm going to shout out a number for each one. And what I want you guys is to be able to allocate whether it's a high, a low, a open, or a close to each of these. Okay. So I'm going to give you guys some time to try and write this down. Okay. Okay. Now, what we're going to be doing now, like I said, I'm going to shout out a number, okay, to the corresponding point. And you're going to need to tell me whether it's a open, low, high, or close. Very simple, okay? So point 1 that we've marked now, what is that? A open, a low, a high, or a close? I'll give you a couple of seconds. Boom, boom, boom. It's a high. Number 4, what is that? It's what we call the low, which makes number 2 the it's on the right hand side, therefore it's the close. So number 3 then we call the open, seeing as it is on the left hand side. Now for that bar, is it a bullish or a bearish bar? From left to right, do we go up or down? From left to right, we go up. Therefore, this would be a bullish bar. Okay, so I'm just going to do it by dragging diagonal lines over it. Okay, next one, right? Number 1, what is that? It's the high, which makes number 2 the on the left hand side. That's the open. Therefore, number 3 then is, what is number 3? This is where it's going to get tricky. It's the close because it's on the right hand side, but also the low because there is no wick below that point. Therefore, the close is the lowest point it reached. Therefore, refer to point 3 as the close and the low. Okay, bullish or bearish candle. From left to right goes down. Therefore, we connect the open and the close. Okay, and we color the body. Okay. Number 1. That's it. It's the open and the high. Number 3. That's it. It's the low, which means number 2 is on the right hand side, therefore the close. Bullish or bearish. From left to right goes down, therefore bearish. Okay, so we connect the open and the close. We color the body. Bearish candle. Next one. Number 1. It's the high, that's right. Number 3. It's the low, that's it. Therefore, number 2 is left hand, right hand side. Therefore, it's the open and the close. Now, that specific candle or bar gets a special little name. What is that? No, that's not consolidation. Okay. This specific candle gets called a doji. Okay. A doji means the similar thing as to what consolidation means. It means unsurety within price movement. But here's the difference between a doji and consolidation. Okay. A doji is a single period, a single candle movement. Okay. So it's one candle that opens and closes at the same point, having gone up and down. There's unsurety as to where it wants to go. Therefore, we're seeing the open and the close at the same levels. This tells us that within a candle, there's unsurety. But consolidation is built up over numerous amount of candles. So a doji is a single candle, whereas consolidation is formed out of many candles. Okay. Therefore, we can't call this doji consolidation. Yet we can refer to it as unsurety within price, same as with consolidation. Consolidation is unsurety within price. Okay. But consolidation consists of multiple candles, whereas a doji is only a single candle. Okay. Right. Next one. Number 4. You should know this at this point in time by now. It's a low. Number 1. It's a high. Number 2. To the right hand side, therefore it's a close. Number 3. It's the open. Bullish or bearish? From left to right it went up. Therefore, this one is a bullish candle. Okay. Next one, number 3. That's it. It's a close. Number 1. It's a high. So number 4 is there for the low, which leaves us with number 2, which is the open. Bullish or bearish? From left to right, down, therefore bearish. Okay, so this is just going to get connected and colored in as well. Okay, just to cover that point. Okay. Right. Now, hopefully this clears up a lot of misunderstanding that you might have had about candles or bars, those type of things. It's a little exercise that I always run through just to make sure that everybody's on the same page, everybody catches exactly what happens and that kind of thing. Like I said, you can practice this at home as many times as you want to, just get a feel for it. But in the end, these are so easy to read once you understand how to identify each point and what they mean. Okay. And that's what a lot of places actually don't tell a lot of people, unfortunately. um, that's why I believe there's a specific method and approach that you need to take in order to teach people how the markets work. Otherwise it's all just wasted effort. It's not going to help the people that's trying to trade the market and that kind of thing. um, and it's not going to really help any training provider or company and so forth, because they're not going to get the results for the clients that they're claiming or those type of things. Okay. Right. Anyway, good little exercise that we ran through. Okay. Next one. What we're going to be looking at now. Okay, I don't know why I got onto this one, but let's just quickly flick through. We've got the market trends. We've done that. Done the candle, done the bars. Boom. Okay. That is a normal price chart. Okay, we're getting into the next little process, which is quite important within trading. Okay, it's what we call and refer to as trend lines and support and resistance levels. Okay, now the chart type we're looking at this point in time is a candle chart. You can clearly see the green and red bodies within this. Okay, if you're struggling to see it, I'm just going to zoom in slightly so that you guys can get a bit of a better viewpoint onto this. Okay, you see there? Okay, look at the flow it's got. You see the little bodies that's coming around and that kind of thing. So the flow basically goes all the way through, but you can clearly see the fat bodies and the narrow little wicks going up and down. Okay, now trend lines and support and resistance lines. What I need you to understand about that is this is going to, like I said, it's going to form an important basis within your trading for one of your systems or strategies and that type of thing. This is another analysis tool that we tend to use. This just better kind of grades the overall direction a chart is heading in. And in order to draw any of these lines, all we need is 2 points. Okay. Now, here's the thing. There's 2 different types of lines, trend lines and then horizontal support and resistance lines. So trend lines are normally diagonal in direction, whereas support and resistance levels, they tend to be flat horizontal lines. Okay. Now, trend lines, they've got a specific method of drawing and placing them. There's a right way and there's a wrong way. Okay. So what I'm going to do is I'm going to give you guys another little example here. Okay, let's say we've got an upwards moving market. Okay, what would be the best place to use to draw a trend line? Now, you need 2 points for any trend line. You either connect a low with a low or a high with a high. So I'm either going to connect a low point with a low point, or I'm going to connect a high point with a high point. Okay. Now, in an upwards moving trend, which do you think is going to be the better ones to use? Do I collect the lows with the lows or the highs with the highs? Okay, check here. Let's say I'm going to go and I'm going to connect the high points like there. What do we know about this trend? Is it bullish or bearish? It's bullish, isn't it? We know this is going up in value because it's going with higher highs and higher lows the entire time. So we know this is an upwards moving chart. Okay. So what is this chart going to tell us? As soon as we get price breaking the line over here, okay, and continuing going up, what is this telling us then? Nothing. Okay. We know this is going up. We know this is bullish. Okay. So if it breaks the line to the top, it's not really telling us anything. This is why in a bullish section, okay, going up in direction, we never ever connect the highs. We connect the lows with one another. Okay. So what I'd actually do in an upwards moving market is I'd take point 1 and 2 and I just extend the line, okay, to indicate the trend of the chart. Now, when I'm going to get this broken by price, what is this most likely telling me? That I've got to change from an upwards moving direction to a downwards moving direction, most likely. You see, so we're using these lines to determine when a trend is going to be changing. So in an upwards moving market, I will connect the lows with one another. This means that in a downwards moving market, okay, I just do the opposite. So in a downwards moving market, I'd connect point 1 and point 2, and then I just extend the line. So that whenever I get price breaking the level, I know that there's most likely a change in direction happening. Okay. So it was trending downwards. I connected the highs with one another, only 2 points. Then I extend the line. Okay. And whenever this line gets broken to the top, then I know there's most likely a change from a downwards move to the upwards move. If I connected the bottoms, okay, with one another and it broke downwards, okay, that's not going to tell me anything because I know it's going down. Okay, so you can see now, remember, when drawing trend lines, in a bullish direction, lows with lows. In a bearish direction, highs with highs. Okay, and that way we can identify whether there's most likely a change in direction coming up or not. Okay, right. Now, getting back to the chart that we've got here, is there any formations that you guys can spot within this chart as it is? It should be. There's many here. Okay. Classic, classic. Boom, boom. There we go. Okay. So we've got an upwards move, a retracement happening. Then it makes a higher high with the next flow. Okay. Basically goes down again, comes back up with that little line there, but forms a lower high. So when you're seeing the high set out like that, okay, you've got the high, so you've got a higher high and then a lower high all of a sudden. That starts setting up the head and shoulders move. Now, for a head and shoulder to be confirmed, what we need, okay, and let me show it to you in a bit of a easier way. I've got price trending up, then all of a sudden it comes down, goes back up, okay, makes the higher high, comes down, goes up, starts coming down, and at that point in time, we can see that there is what we call the shoulders and the head. Now, this is normally a trend reversal pattern. So trend has been going up for a while, okay? Forms basically that ultimate high there, and then all of a sudden it forms the lower high over there. And once it starts going down like that, then we know that this is most likely a head and shoulder setup being formed. So how do we confirm this again? We connect what we call the shoulder lines. Okay, so it's the inside points of the shoulders, the lows on the inside of that, okay, that we connect, and we extend the line, and that's what we call the neckline. Once we get price breaking, okay, from above to below the line, in other words, price moves down past it, okay, and confirms. In other words, that candle right there is the one that broke it, okay? And that one there is what we call the candle that we're going to enter on. So the first one is the confirmation candle, the second one is entry candle, okay? So once we get that happening, okay, what's our target? Our target is the distance from the neckline straight up towards the head. That same distance is what we're going to be aiming for down as the target, okay? Did we get to that point? Yes, we did. Okay. Stop would be obviously at the most recent high when we're going for a short. So that's basically where I do my stop loss placement. Okay. Then we get price moving again, goes up, down, up, down, up, down, and so forth. And what we've got is we've over here got a triangle forming. Okay. Breaks up. We've got price running again, and check here, comes down, okay, and forms what we call the double bottom. You see how those two sections, they're running literally with those eyes, very perpendicular with one another. They're spot on that level of 66. So basically, and they're also spot on with this support and resistance level over here, okay. When we get that formation happening, it breaks. That same distance that we just checked from that low to that midpoint, okay, is the distance we're going to aim for as profit once we get the confirmation of the break upwards. And we clearly reached that point as well, okay. So that would have been a nice double bottom trade there, okay. There's many of these formations popping up and over, one after the other, okay. But that's to kind of show you guys some nice formations. Now, here's the thing. There's one or two things that happens whenever price gets to any of these lines, whether it's a trend line or a horizontal support or resistance line. Okay, one of two things. It either bounces or it breaks like at point 3. Okay, breaks, 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 bounce, 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 bounce. Okay, one of two things will always happen at these lines. Price is either going to bounce or it's going to break. Problem is we don't know which is going to happen. But we do know that one of the two can happen. And because of that, we can plan for either of the options spanning out. The trick is to wait for the market to show you what it's actually going to do. Okay, so wait for it to show that it's either bouncing. So wait for it to confirm that it's bounced or confirm that it's broken. Okay, it's as simple as that. You let the market show you what you need to do. Okay, that's the key factor. So knowing this knowledge makes it quite useful in terms of using these support and resistance levels. Okay, so check what happens. I mean, this it works like clockwork. Okay, so at point one, we've got the bounce. Okay, so price comes down, breaks. Okay, goes up. Now it hits the support and resistance level, bounces, goes up, bounces, bounces, goes down, bounces, goes down, consolidates slightly, and then it breaks upwards. Now look at what's happening here. Okay, we're getting this line where it was broken from the bottom upwards. Price comes back, tests it, goes up, comes back, gets close, okay, to test it, goes back up, comes back down, breaks it heavily, okay. But look at the lows from this point onwards. It's a low, it's a higher low, higher low, higher low. So price tries to keep on pushing the lows higher and higher and higher, but the highs can't get past this level. So what are we seeing? Remember that coil I explained earlier? Price is being squeezed, momentum is being built, and as soon as it breaks, boom. Okay, comes back down, tests the level again, goes, test the level again, goes up, okay, breaks the level, slightly consolidates, bounces off the level, and runs. Comes back all the way, tests the level again, goes up, comes back down, tests it again, goes up, doesn't really have any idea what it wants to do. Sudden drop towards the level again, goes up slightly. Now we've got another confirmation happening very soon here. The price is now broken below that level. Okay. Now, this is all good and well. This is awesome to see and so forth. In hindsight, this always works. Hindsight. Problem is we don't trade a hindsight, do we? We trade unseen prices. So how the hell do we use these lines to determine what we need to do without knowing what's going to happen next? That's the key question, the trick thing. Okay, that's what you want to know. Nothing else really, right? Boom. Look at what I've done. I've just taken this section and I've extended the line, okay? And I've added another level. Bounce there, breaks. Bounce there, bounce, 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 break, bounce, 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 okay? Here's the trick. The more times that a line gets tested, bounced off of, okay, the more strength or relevance there is to that particular level. Now, when comparing trend lines to support and resistance lines, the diagonal ones compared to the horizontal ones, okay, which of the two do you think carries more weight? Well, support and resistance lines, the horizontal ones. Why? The fact is that at any point in time, the trend line becomes non-existent. This is going to run continuously, but it's going to get you below the chart at one or other point, or it's going to move out of the chart, okay? Not be in contention with being used again in the future. But a horizontal line sets to a specific level. It links to a price. And these horizontal levels gets tested over and over and over and over and over in the future. I mean, I've got certain lines that are about 6-7 years old, okay, on some of my charts that are still getting tested and bounced off of. Okay, it's insane how good this works. Okay, so try and plot these lines, and I'll show you in a couple of minutes how we go about doing that. Okay, but it's an awesome little method of finding out whether you might hit a little bit of trouble, okay, with the next move coming up. Let me show you what I mean. I'm going to go back one slide again, okay? You see the section there. We had the upwards moving trend line being broken by that red candle over there, okay? Why would I not have taken a sell or a short trade there to make money as the price goes down? I mean, it's a clear signal for change of direction, isn't it? That is what I'd call a false break. Okay, let me show you what's actually happening here. That little section there is a false break. Broke through, yes, but look how close that horizontal level is. Okay, we can see that it's been tested over and over and over there, over there, over there, there. One or two things can happen when price gets to a level. It either bounces or it's going to break. So even though I got the break here, because I had this line over here so close, I'd rather wait for price to break that line as well. Then I'd go for the sell position. So that one I never would have taken. I would have waited. I've seen that it went back up. Therefore, I would have traded the other direction. You see the difference between predicting and waiting for the chart to show you what's going to happen? There's a huge difference in analysis, okay? And it makes it a lot more simpler just to wait for the chart to show you what it's going to do. The amount of mistakes you're going to make of reading false signals, that kind of thing, it's going to be a lot less as well, okay? It just takes practice. That's the main thing, okay? But anyway, let me show you how we target and use these lines to determine, what we're going to do. So let's say, obviously, at the break of this section over here, let's quickly just show. There we go. Okay, so we're at the break of the trend line over here. So let's say we're going to use this as an indication to get into the market. Okay, so I would get in at that level. I would set my stop loss at that level, and I would use the horizontal line. That is my target 1, and that is my target 2. Okay, because one or two things can happen when price gets to that level. Now look what happens. Let's say price goes down. Don't you think it's going to be a smart idea to take off some profits right over there just before it gets to that level? Okay, take off a portion of the trade, maybe a third of it. I'm in the profit, okay, because it's moved in my direction. Once it moves against me, I'm losing money. So wherever I enter at, okay, my entry is going to be the gauge of whether I'm going to be making money or losing money. So if I'm entering for the short, whenever I'm below the entry, I'm making money. Whenever I'm above it, I'm losing money. Okay, the further above it goes, the more I'm going to lose. The further it goes lower, the more money I'm going to make. Obviously, for a buy, it's the opposite direction. Okay, but the same principle applies. Why do I want to take money off here and not on the level over there? Because of that happening. You can see that price sometimes gets close and then actually turns. It doesn't always hit the level like over there. So I'd rather take money off just before it hits the level, before it starts turning. Okay, I'll still keep rest of the trade open, but what I'll do then is I'll move my stop loss, okay, to my entry level. That means that whenever price goes, and let's say it does bounce off of that level and continues going against me, when I get to the entry level, because my stop loss is placed, it'll close the trade automatically there. So if I get out at entry, I'm not winning anything or losing anything. And I've already taken some profits. At that point, it's what we call a free trade. I can't lose anything. Okay. Now, if price does decide to, at a particular point, actually break past this level, my next target would be to take off money just before it hits that level. Okay, same reason as before. One or two things can happen when price gets to that point. Therefore, rather prepare and make sure you're safeguarding yourself so that if price does go and actually starts bouncing off of that level, you've already taken some profits. Now again, I'll move my stop from entry to target 1. Now my stop loss is sitting at a profitable level. So even if price goes against me now and hits that point, okay, I'll get out with money. Again, if price continues breaking downwards, even better. But that is how we're going to use these lines to determine what we need to do without knowing what's going to come in the future. It's because of the fact that we know one or two things can happen. It's either going to bounce or break. Because we know that, we'd rather take some profits off before we get ourselves into a dangerous point. Okay. It's preparation. It's all it is, guys. Okay. Right. Now, we're getting to the age-old argument. And I mean, this debate is still going, strong and strong and strong between all novices. Okay. The real question for all novices always comes down to which type of analysis on a chart works better, okay, or any instrument. Is it fundamental analysis or technical analysis? Now, everything I've been showing you so far at this point in time has been technical analysis. It's looking at technical movements of price on a chart. That reflection and analysis of that is all technicals. Now, what is fundamental analysis? Fundamental analysis would be, let's say, when you're looking at a share price, okay, you'd be looking at maybe any of the deals that the company's lined up for, future contracts and so forth. You'd look at who the directors are, which boards they've served on before, how well those companies have performed. You'll do a much more in-depth type of analysis onto the actual structure of the company. You'll go through their financial statements, any news releases that comes out. All of those things are seen as fundamental analysis, okay? While technicals is purely based on movement of price on the instrument. Okay, so which do we use and which works better? Do we use only fundamentals? Do we use only technicals? Or do we use a combination of both? Here's the thing. Okay, I'm going to clear this up for you guys for now and always. It's very simple, actually. We are trading. We're not investing. We're in for short-term speculation and profits. Therefore, we will only ever use technical analysis. Now, fundamentals has got its place. I'm not going to lie, okay? But fundamentals you're only really going to use if you're looking at investing for the long term. Then you want to know who the directors are. You want to make sure that this blue chip has got the investment set in the proper sections and so forth, okay? All of those things matter then. But to go through all of that effort for what we are going to be doing, it's a waste of time. Okay. Not only that, the problem I've got with fundamentals is that fundamentals creates a biased view on something. Okay. Whereas when you're looking at technicals, you're looking at what the chart is showing you, and you just need to leave it to show you exactly what it's doing. Whereas fundamentals, it takes kind of all the different little calculations and it starts forming an opinion. So the fundamentals might tell you that the chart's going to go up. Now you start forming this biased opinion that price is going to go up. So what do? You're analyzing the chart then, and all you are looking for is any signal that can generate an entry for a buy. But now you're forgetting to look for any possibility of a short coming up, because now the fundamentals has created that biased opinion that the chart's going to go up. So let me explain it to you this way. If any news release or anything like that is going to have an effect on price, don't you think that it's going to be shown and reflected on the price chart anyway when it's happening? So why do you want to go through all the effort of finding out exactly what it's going to do if you can just check the chart and see it happening and basing your decision off that? See what I'm getting down to? Okay. Fundamentals is a waste of time for trading. For investing, it's extremely important. Okay. Know the niche you're going for, know the approach you're going to take. Okay, we will only use technicals. There's no room for fundamentals in here because fundamentals is only going to create a biased opinion. You're going to be looking for things that's not there, and you're going to have things jump out of that screen that you want to see, not that you should see. Technicals uses a more broad approach of actually acting on the chart as it's happening. Okay. Like I said, guys, the fact is trading is supposed to be easy. The problem is most of us make it difficult for ourselves because we think the more analysis we do, the deeper analysis we do, the better we're going to get, with our results and trades and so forth. Guys, you're only going to confuse yourselves more and more and more. Okay, and there's a specific approach we take. And once you've mastered that approach, you're going to notice that trading is really, really easy, actually. Okay, in the beginning, it's going to take a lot of time, a lot of practice and that kind of thing. But like I said, once you start getting into this, it is fun. Okay. So if I do ever catch any of you doing a lot of fundamental analysis and it's on derivative instruments, Okay. Walk out the door. I haven't got room for you in my classes. I'm serious when I'm saying that. Okay. Because the fundamentals is only going to create issues within your trading. Okay. Right. Next part. Now we're getting into the logistics of different types of indicators. Okay. Now, the indicators that we're going to use to help determine what we need to do on the charts is going to become a very important thing. Okay. They're going to help us to determine whether a chart is trending, bullish or bearish, or whether a buy or sell signal is being generated. Okay, so for those features, we've got specifically two types of indicators. There's leading indicators and then there's lagging indicators. Okay, leading indicators do exactly what they say. It leads price and it tends to give early entry and exit signals. So it tells us when to get in and when to get out. Okay, they usually consist of what we call momentum oscillators. Now, oscillator is nothing more than something that is range bound. So it'll be something like a MACD, a stochastic, a RSI. Stochastics and RSIs are basically range bound between a 0 and 100 level. The MACD is an oscillator because it oscillates around a central line, which is the naught line. Okay, so it's something that is basically range bound. That's all that an oscillator means. Okay, they're best used in trading markets. In other words, actually sideways moving markets. You're going to notice that, especially in the Forex markets, when you're looking at the shorter time frames, you're going to see a lot of sideways movement. There's going to be a lot of up and down movement, but overall, in a longer looking format, you're going to see price tends to go sideways. Okay, it's because these indicators tend to give a lot more signals a lot more often, so they work well in consolidation periods. Okay, they can be used in trending markets as well. But when we use them in trending markets, we only use them in the same direction as the major trend. Okay, so if the overall trend is bullish, we will only take buy signals that any of those indicators gives us. If it generates a sell signal in a bullish market, we ignore that, we don't take a trade, and we wait for the indicator to go further down and start setting up for the buy signal, and then we take action. Okay. Now, the cons to these, unfortunately, are that because they're giving a lot more signals as well as earlier, the chances of getting false signals are a lot greater. Okay. This is why we make sure we use it specifically in the direction of the trend, because at least half of the crap signals are taken out of the equation then. Okay, you're still going to get false signals every now and then, and especially when you're using these in the wrong type of market cycles, you're going to notice that you're going to get whipsaw conditions. So you're going to get in, direction is going to change, it's going to take you out, so you've lost a bit of money. You're getting in the new direction, it changes again, it takes you out, and this continuously happens. And all that's happening is you're starting to, lose more and more and more and more, and it eats away on any of the profits that you might have made already. Okay. Now, examples of these types of indicators are what we call the CCI, or Commodity Channel Index. We've got the Momentum or Rate of Change Index. We've got the Relative Strength, or RSI. We've got the Stochastic Oscillator, and we've got the Williams Percentage R. Now, these are only a few different types of indicators. We've only what I've done is I've taken the most commonly used ones and put them down for you. Okay, guys, you can learn any indicator you want. I really don't care which you learn, which you go for, and that kind of thing, or what you want to use. There's hundreds of them out there, but I've taken the most commonly used ones out there so that you guys understand them as well as possible. And from there, you can branch out any way you'd want to. The key factor is to understand these indicators to the T. Know when they're indicating that the chart is moving up or down, or when they're indicating that the chart is signaling an entry for a buy or an entry for a sell. The better you know this, the more skilled you can get with the analysis on the indicator, and you can actually start playing around with settings on these in such a way that you start reading these in a completely different way than the norm. Remember, the norm doesn't get it right. Okay, so I'll start showing you guys a lot of different ways and methods in terms of reading something like a MACD. There's basically two signals that everybody knows of on the MACD. Okay, it's the moving average convergence divergence. Okay, now the MACD, it's either got the signal line cross or the naught line cross, but there's actually even more. Okay, but I think I'll only tackle that in the next session. It gets down to the point of seeing the indicator from a different set of eyes than what the norm does. Because of that, it gives you a slight edge compared to any of the other traders out there. Okay, and this is also going to start helping you think outside of the box with the approach of your analysis. As long as you stick with the methods of approach and the process that I'm teaching you, how you go about it, I don't care. Okay, because the process is the most important part in all of this. Okay, right. Now, that's leading indicators. The next one is basically lagging indicators. And lagging indicators, they're a lot slower. They're trend following indicators. So what you'll notice is that these tend to react a lot slower compared to something like a leading indicator. So price will change direction first, and only later will the indicator show or confirm a change in direction. Okay, and it's purely for that fact, because they are a lot slower, that we're never going to get in right at the bottom or right at the top. It's not going to happen. Okay, these work best in strong trending markets. Okay, they're basically designed to get you in and keep you into that trade for as long as that trade has got its momentum and stays intact. Okay. Now the cons with these, unfortunately, they give us very late entries and exits. Okay, so for entering and that kind of thing, it's not always the best, but you can get some good systems with these, definitely. Remember, we use a mixture of lagging and leading to have them complement one another and have one eliminate the other one's weakness. Okay, they are going to produce a lot of false signals in sideways moving markets. Okay, because you're constantly going to get change of trend, change of trend, change of trend, change of trend. Okay, so it's also going to give you those whipsaw conditions. Now, examples of these again are moving averages. Okay, and moving averages can be leading when you set them to 10 or less. Okay, but a moving average is a simple line that kind of just gives an averaged view of price flow. Okay, the MACD, which I've already explained, that's the moving average convergence divergence. Next one, it's a mouthful. Okay, the Ichimoku Kinko Hayo. Okay, it means at one glance. It's a special indicator that was developed, if I'm right, it's also in Japan. Believe it or not, this was a news reporter who developed, a normal reporter for a newspaper that developed that indicator. Okay, uses 5 lines, and it's one of the few indicators that can be used completely on its own to determine trend direction, consolidation, entry signals, exit signals, all of those things. Okay, it's an insanely powerful indicator. It's a difficult one to learn and master. Okay, it took me 7 months to master that little beast, but it's only because it's a long-term indicator. Okay, so you start off using it on daily charts, so it's going to take some time for you to build up positions, ratchet, all those different types of things. Okay, and once I got the hang of it on the larger time frames, I started bringing it down to the smaller time frames. Okay, getting a lot faster and faster and faster. I mean, I used it successfully up until the 1 hour charts. Going lower than that, you're going to need to play around with the settings quite a lot. Okay, um, but yeah, it's more of you're going to want to find a nice trending chart, a chart that often gets into nice big trends, to utilize that indicator to its fullest. That's a beautiful little indicator, and I've put that there for one specific reason. Guys, if you can learn and master that indicator, you can master any indicator out there. Okay, right. OBV, which is on balance volume, and parabolic SAR. SAR is stop and reversal. Okay, it's a nice little indicator. I don't really use it a lot at all. I was just there so that you guys can, understand exactly how it works, what it is. Play around with as many of these indicators as you can. Go through the videos as many times as you can. A little tip as well: use these indicators on a smaller time frame in the beginning, like 5-minute charts or 1-minute charts, to see how the indicator gets plotted as price moves. Okay, and if you're going to set it to a 1 hour, you're going to have to wait 1 hour every single time for the new plotting to happen. Okay, so the shorter time frames will just happen with a quicker span, so you'll be able to see the way they flow a lot quicker. Also, when putting indicators onto your charts, especially when starting out, guys, do not put more than one indicator on a chart at a time. Okay, rather open up 3 charts of the Euro US and put 3 different indicators, okay, one on each, but different from one another, and analyze them completely on their own, okay, in conjunction with price to get a feel for how they flow with price first. If you're going to put more than one indicator in the beginning, okay, I mean, I've seen guys putting 8 indicators on a chart, okay, guys, it's only going to confuse you. 5 of the indicators are going to tell you that it's a bullish market, 3 are going to tell you that it's a bearish market, and another 2 is going to tell you that you need to sell, 1 is going to tell you have to buy. Now what do? That's huge confusion that you're going to sit with. It's only going to create more issues than anything else. Okay. We're only going to start off with using 2 indicators when we start building our systems and strategies. Okay. On my stochastic setup, I really only use stochastics. Okay, and then I use another indicator for my final confirmation of getting it, just to keep me out of false signals. I'll explain that in the next session when we get to that point. Okay, but all in all, do not use too many indicators in the beginning. Rather learn them individually first, get a feel for them, and then when we get to the second session, I'll show you how we use them with one another. Well, we're going to start looking at it at this point in time. But all in all, guys, this is what I refer to as a little cheat sheet. So I'll obviously be emailing you the notes for this, okay? And what you're going to do then is you can print this and you can stick it up right next to your trading screen. All the leading indicators on the left-hand side, all the lagging indicators on the right-hand side. You can see, especially from the second column downwards, okay, on the rows, you'll basically notice that they are going to be the similar indicators, okay? Just hold on. Okay, so CCI you'll see has got leading and lagging, MACD leading and lagging. You've got the ROC, which can be used as leading or lagging. Bollinger Bands is basically leading. It's a very nice little indicator. So, I mean, it's nice for confirming double tops and bottoms, those type of things. Very nice for spotting consolidation and momentum buildups as well. Okay. ADX, very nice to use for entry signals when looking at the plus and minus DI levels, and then as well to spot consolidation and that kind of thing as well. So we use these in various different ways, and we mix and match them up so that we don't have 2 indicators doing the exact same thing. Okay, we'll use one indicator to determine trend and another indicator to determine entry into that trend. Okay, right. So in the end, to bring it all together, guys, trading is like game of odds, out and out. Okay, technical analysis helps us to put those odds in our favor. Okay, now we can never be correct all of the time, but we find big losers most of the time. All done with the risk to reward ratio. Now, the risk to reward ratio is a very important thing. We're going to handle that in detail in the next session. But in the end, what I want to do is I want to kind of show you guys the true flow of odds. Okay, a lot of people have got a big misconception on the way in which odds work. Okay, and I like to use the coin game to explain that to people. Okay, so let's just quickly get the slide up and running. This is the last section, guys. We're almost done, so in about 5 minutes we're finished. Okay, but with a coin game, okay, when we're flicking a coin, there's basically only 2 sides to a coin. There's heads and there's tails. Okay. Now for this game, what we're going to do is we're going to take an imaginary coin and we're going to flick it. We're going to flick it in a total of 10 times. Okay. But we're going to make this interesting. What we're going to do is we're going to add a couple of rules to this. Okay. What we're going to say is that whenever the coin falls on heads, you guys will win. But if it falls on tails, I win and you lose. Okay. So when it falls on heads, you will gain $20. But if it falls on tails, you've got to pay me $10. Okay. So you're trying to go for a reward of 20, okay, with your risk being 10. So I'm trying to make double as much compared to when I'm losing. It's basically how the rules are laid out with this. Okay, so we go and we start and we flick that first coin. Flick it, flips in the air, falls down. And what do we get? We get a tails. So you've lost. Okay, you pay me money. I'm $10 up. Okay, so you still want to play? Let's go and flick on. Flick number 2. Flicks up, goes, falls on the counter, and it's a tails. You lose again. Okay, still want to go on? All good. Flick it a third time, and what do we get? Tails. Okay, let's pause the game at this point in time. Okay, I want to ask you guys a simple little question. What is the chances, the odds of the coin actually falling on heads? It's 50-50, isn't it? So there's a 50% chance that it's going to fall on heads. This is mathematical fact. Okay. Yes, I do get the smart asses every now and then saying, "Oh, but what if the coin falls on its side or anything like that?" Well, it's a rethrow. Okay. Well, what if the coin is weighted? There's no such thing as that. We're just taking a blank chip and we're coloring the 1 point white and the 1 point black. Whatever it falls on is what it falls on. Okay. You can go about this any way you want to. But if you go and check this out, you can even go and Google it. Okay. Um, percentage odds for coin flicks, okay, you will see that mathematically it is fact that there's a 50% chance of it falling on heads. So if we know now that there is a 50%, okay, there's a 50% of this going our way. What's the amount of times, percentage-wise, that it's already fallen on heads? Out of 3 throws, it's naught, isn't it? Okay, is 0% a true reflection of what we factually know to be the odds of 50? All good. Okay, let's continue throwing. So we throw it another time, and what do we get? Tails again. That's 4 throws going against us. You still want to play? This is what happens within trading a lot of the times, guys. Okay, percentage of times it's fallen on heads, naught. It's not a true reflection of the odds. Yet we get this happening every now and then. We continue flicking and boom, finally we get a head. So out of 5 throws, we had 1 only falling, okay, on heads. That means 20% of the time so far, out of 5 throws, we've had heads being hit. Okay, is that a true reflection of the factual odds of 50%? No. Is it closer than what it was before, which was naught? Yes. Okay. Let's continue with the rest of the 5 throws. Okay. So we throw, what do we get? Boom, heads. We throw again, what do we get? Boom, tails. Throw again, heads. Throw again, tails. Throw again, heads. That's 5 throws done. You can see there was more or less a 50-50 split with the fall of those flicks. Okay. In the end, we've got a lot more losers than we've got winners. Okay. Let's check now. What's the amount of times that the coin has fell on heads? We've got 1, 2, 3, 4. So obviously we've got 1, 2, 3, 4, 5, 6. Okay. 6 times 10. We've lost 60. 4 times 20. We've gained 80. Therefore, we've ended up with a profit of $20. Okay. Now, 4 out of 10 throws fell on heads. This means that we came down to this point of being correct 40% of the time. We know that factually this is going to fall 50% of the time on heads. So, is this closer to the 50% than what it was before? Yes, it is. Okay. Now here's the thing. We were only right 40% of the time, and we still made money. How can you not want to trade? Okay. The trick is in gearing your risk to reward in such a way, okay, so that it actually makes it a lot simpler. Okay. So if you gear your risk to reward in a proper way, you can be as wrong as many times as you want to. When you're right, you're going to wipe out all of those wrongs. Okay, that's the key process. This is why you've got to accept the fact that you're going to get losers. You're going to, most of the time, they're going to be more than what the winners are. But it just means that because you're getting a loser, doesn't mean you've done anything wrong. It just means that the odds did not play out. Okay. What do you think is going to happen with that hit rate, that 40% that we've got so far of it having fallen on heads? Okay. If we push up the amount of throws from 10 to 20, is it going to get closer to 50? What if we push it up from 20 to 100? What about from 100 throws to 1,000 throws? Do you see the difference here? True odds only shows itself after a numerous amount of flicks. And this is the issue that we've got within the trading world. Remember, we're playing a game of odds. Okay, therefore we need to allow a system to build up certain amount of trades to start reflecting the true results. The problem is most people, about 90% out there, judge systems on the first 4 throws. And we've seen here that all first 4 went against us. This is a normal thing to have happen. Okay. But what I want you to take out of this little exercise is the fact that odds really only starts producing and showing itself after a numerous amount of tries. Okay. So you can't judge a system off of the first couple of flicks or tries. Okay. This is why we go through the backtesting process, to make sure that we get a very good set of odds, instead of only testing a short period. And I mean, well, you can just forget about it. You're not really going to get anything happening at that point in time, okay, because you're only lying to yourself. Okay. So in the end, guys, all I want you to know at this point in time is the different components that the markets consist of. I need you to understand how odds work. And I need you to focus on learning those indicators as good as possible. You're going to get questions, you're going to have them, that kind of thing. All good. That's what I want happening. Remember, any questions that you come up with, either give me a phone call or send me an email, and I'll reply to you as soon as possible. Okay? And clear up any of the doubts and so forth that you've got. Okay? What I'm going to do then is basically at the start of next week, I'm going to be sending you the notes for this presentation that I've just done, and I'm going to be sending you your assignment as well for me to complete. Please do me the favor of just running through the videos again, okay, that you've done already for the theory parts and those type of things, okay? Because now you're going to notice, because I've kind of just taken everything and built the bigger picture for you to understand. Now you're going to be getting a lot of aha moments happening. Okay, and that's exactly what I want happening. Okay, like I said, any questions that come up as you're going through any of that again, any unsurety that there might be and so forth, all you do is you let me know. Okay, and we'll tackle it right then and there. I don't want any of you going into this and have any doubts on any point whatsoever. We need to eliminate all of the doubt, because the fact is, with doubt in trading, doubt is the biggest killer for any trader. Okay, so whenever in doubt, stay out. As simple as that. Okay, guys, that's it for the session. I know we went over about 10 minutes. It's not that bad at all, actually, but there's a lot of stuff that we did cover. And also, you know, like I said, any questions and those type of things that pop up, feel free to give me a shout and that kind of thing. Okay. Otherwise, guys, I will send you the homework and those type of things coming week, and just complete them as needed. I need them in before the start of the next session. Next session is obviously going to be next month. Okay, so you've got about a month's time to prepare and that kind of thing. Do your exercises, do your homework, take those trades. I really don't care if you lose money or wipe the account. It's all demo money. Okay, so it's not real money. If you wipe the account, brilliant. Okay, you've kind of already have had a taste of what could happen. It's exactly what I want you to see. I want you to struggle in the beginning first, so that your eyes are opened to the extremes. Okay, and then we'll show you methods and ways of how to counter those. Okay, so you're going to notice this is going to be a very practical application of skills and so forth that we're going to be running through. Okay, and yep, like I also mentioned, I'll be working with each of you individually quite a lot as well as we progress through the course. Okay, otherwise, guys, that's it. Thanks for joining me for this session, for those of you who did log on and register and so forth. And then I will see you guys again next month. Okay, enjoy the rest of your weekend. Cheers, guys.